I'm going to just start the recording in like a minute just to so that it's all all going and it doesn't cut out anything in the
Okay,
beginning.
perfect. Okay, for everyone who's just joined, we're going to start promptly at 5 past just to give everyone a chance to join. So this would be a good opportunity if you want to get yourselves ready, get some popcorn, maybe a cold drink or coffee, and then we'll start promptly at 5 past. Thanks. We will have a break in between after around about the halfway point, but I'll leave that in the hands of Hugo and Matthijs, and we'll keep you informed. Watch the space.
Hi, and welcome to all those who are joining. We're still giving a couple of minutes for those to still log in. We less than halfway with attendance, so we're just waiting a couple of minutes to for others to join. We'll be starting at about 1:05.
Okay, so welcome everyone. We've got a half a minute to go, and thank you, Hugo and Matthijs, for presenting today. Uh, Very topical subjects, something, I suppose, Forex and tax, something which we all lose a little bit of sleep over, and hopefully at the end, maybe relieve some of that pressure for us and by explanation. And so we will be breaking at about halfway. And then Matthijs will be presenting after Hugo. And so I'm going to hand it over to Hugo now. And Hugo, the floor is yours.
Thank you so much, Dan, and good afternoon. And Matthijs will speak a bit later, but thank you, Matthijs, for helping. I did the final slides, but the majority of the slides comes from Matthijs. So just to explain to everybody, I've been doing exchange control and cross-border tax since 1993, roughly the time that Chris Hani passed away. We had a lot of South Africans leaving the country, and we then had a lot of South Africans coming back to South Africa. And a big part of them was obviously the so-called refugees or terrorists, whatever you want to call them. It was the people that were living outside South Africa. That obviously led to the first amnesty in 2003, which was the tax and exchange control amnesty. That's when I made tax and cross-border my only source of income. So up to then, I had an audit practice. So I did a bit of accounting, auditing, but I focused on cross-border tax. And it was actually quite interesting to see that in the 1993 to 95, 6, I would say, most of my clients were South Africans, white South Africans leaving. From 97 onwards, right to 2000, majority of my clients were actually non-whites or people of color coming back to South Africa, which was obviously at the time an extremely good positive sign. And there was quite a bit of pressure on government to help those people coming back into South Africa to clear their funds. So since then, regulation or clearing your exchange control mistakes has become much easier. At that stage, exchange control manuals were little secret documents. If you didn't know someone who could give it to you, you couldn't access it. Today, it is totally accessible on the internet. For those of you who want to find it, go to the webpage ResBank, resbank.coza. If you have any questions, welcome to make contact with myself and Matthijs. So Matthijs will introduce himself later. But for those of you asking, he is the lawyer in the group. He did his studies in South Africa, then went to America and later to Germany. So he's well versed in international business and cross-border matters. He is part of a law firm. I'm part of an accounting firm. And together we have a joint venture company called Citus, where we do Forex, exchange control, tax, and a bit of legal advice. We are not a law firm, but we do provide legal advisory services. But I leave that to Matthijs. But very important is that we saw a big change in 2021 when formal immigration, or that horrible word that I so hate, financial immigration, was switched off. Since then, we have the clear principle that cessation of tax residency or tax immigration is the buzzword or the keyword. Although we are not going to go into much detail about the tax process right now, it is extremely important that when you deal with a client's exchange control matters, the place to start is to ask for his or her tax residency status. You could also ask them, are they registered with tax or for tax, or whether they're active or inactive. We'll see later that that can play somewhat of a small role, but you will see that the most critical update that came through on the 19th of June is that the Reserve Bank now has made it categorically clear. If you have not completed tax immigration, you need to get a tax number. So even people who did financial immigration, formal immigration, whatever you used to call the old banking process, where the Reserve Bank gave you a letter to say you're now non-resident and they opened you a blocked account. And we'll see the date. Even if your immigration was prior to that date, you need a tax number if you have remaining assets in South Africa. The exception, the only two category of exchange control residents or non-residents for that matter, that do not need a tax number is beneficiaries of a South African trust and beneficiaries or legatees in a South African deceased estate. But the provision is you must be totally inactive on the SARS system. So if you have a tax number, or your client has a tax number that is suspended because they couldn't collect the debt, there's outstanding admin penalties, that is not inactive. Inactive means your tax number was closed down. But we shouldn't see this Reserve Bank policy change on, well, it's not a policy change, it's just the first time they have clearly stated that. We must see this in the light of the 2025 notification of who should submit a tax return. Not that important for exchange control, but it can have an impact, is any company that has an asset or turnover of more than 1,000 Rand, extremely low. Secondly, any South African who holds foreign assets of more than 250,000 Rand, that definition is so wide, we do assume that they refer to a tax resident. But whilst there are no clarity, it appears that the Treasury and SARS want someone who has foreign assets and a South African ID or any link to South Africa with regulated or allowed foreign assets or illegal assets, because the taxman does not bother himself whether your foreign assets are legal or illegal. You have to submit a tax return. Furthermore, if there's a capital gains tax event with a very small monetary value, you also have to file a tax return. And one can claim that because you're non-resident, there's no capital gains tax unless it's South African immovable property, a title deed, or shares in a property-rich company. But now remember, that assumes you have a letter to say you are tax non-resident. If you do not have that letter of tax non-residency, then your capital gains tax exposure starts at 40,000 because the annual exemption 1,000. Above that, you have to file a tax return. You probably won't pay tax because remember, you then have another 90,000, 95,000 of taxable income before you pay tax. But you still have to file the tax return because your proceeds exceeds 40,000 Rand or your gain exceeds 40,000 Rand. So extremely important. The notion that you can remain off register, inactive on the SARS system without having a letter to say that you are tax non-resident, those days are over. So now we have to look and come back and look at the different definitions of resident. And it becomes extremely difficult in South Africa because we have 3 different systems. Furthermore, unlike most other countries, our ID numbers, or what we use for identification numbers, is not our tax numbers. So in the UK, USA, Australia, your tax number is very much linked to your social security or NHI number. In South Africa, because of historical apartheid reasons, your South African ID is not your tax number. The tax number is a different number. And for those of you asking why, because remember, persons of color could not have a South African ID number. They had the black DOM passbook, but they had tax numbers. So therefore, the tax number system or numbering system was totally separate from the SA ID books, even before we had the green bar-coded IDs. Furthermore, we also have immigrants, that is people living here, that do not hold permanent residency permit. They do not have a South African ID. So in terms of South African Home Affairs law, someone can have a South African ID, but his ID will read non-citizen. That person, without clear definition in the authorized dealer manual, the Reserve Bank's manual for banks, an authorized dealer is a bank, there's no clear indication, but there's interpretation by the banks that says the minute you have a South African ID book with a barcode, or a South African permanent residency letter, a grant letter, then you are deemed to be an exchange control resident. But that does not make you a tax resident as yet. So very important, and we'll try and touch on that a little bit later. We have two categories of people now living in South Africa for more than 6 months, or not more than the 90 days of visitor's permit. And that's the nomad or digital nomad visas and the retiree visas. Those persons do not hold a South African ID, and they are probably not South African tax resident, and they most definitely not exchange control resident. Okay. For exchange control, they will be deemed a foreign national temporarily in South Africa, and they can indeed have a South African bank account in rands, but they are not treated as exchange control resident. So we all know the tax definitions. I'm not going to bore you with that. Let's quickly look at what the Reserve Bank says. And just for you guys, so that if you look at this a bit later and then maybe find that rules have changed, I'm using the manual that was dated 19th of June. It's very recent. Although it was updated on the 19th of June, it was only published on Monday. So it's very, very new. And the last circular that we took into account, and as we started the lecture, I actually looked at the Reserve Bank page. That remains the last circular in issue, and that is Circular 14 of 2025, dated the 19th of June. And that deals with legacies and distributions from deceased estates and testamentary trusts. And that deals with the people who can legally be inactive on the SARS system. But back to the left-hand side, what does the Reserve Bank consider a resident? A resident means any person, a natural or legal entity, who has taken up permanent residence, is domiciled or registered in South Africa. Now that is vague and causes a lot of confusion because a nomad is registered in South Africa. They have a visa. But we think this registered means referring to a legal entity. So it's incorporated in South Africa. So for a natural person, it must be someone who has a permanent residence or domiciled here. Now, domiciled would probably mean someone who has applied for a permanent residency, qualifies for it, but has not been granted such an application, or such a permit. Now, Matthijs and I, through the law firm that Matthijs is associated with, are dealing with several such clients that are at the moment in court with Home Affairs. The new minister in the GNU seems to be bringing down that backlog, but there are taxpayers that need to actually and have indeed approached the court for a court order to force Home Affairs to issue their permanent residency permits. So they will be residents. When a South African born or because he holds a South African ID, so that could be a permanent resident with no South African ID, is temporarily abroad, he is considered or she is considered a resident temporary abroad. So for Home Affairs, that person remains a resident. For exchange control, that person remains a resident. For tax, we need to determine whether that person is resident or non-resident. And the outcome of the tax residency may impact on the Reserve Bank position. But their definition says it means any resident who has departed from South Africa to any country outside the common monetary area with no intention of taking up residence or has not been granted permanent residence in another country. So it seems that if you already have an indefinite leave to remain in the UK, that the Reserve Bank will treat you as non-resident. But such an application process does not exist. One has to go through the tax process first to become non-resident.
Afternoon, everybody. You guys can just maybe add to that a practical example of the residents temporarily abroad. Think of a minor, a person that has left before the age of 16, before obtaining a South African ID. They've subsequently obtained a foreign passport, so they no longer have any what we call SA FICA, no ID book, no South African passport. But their foreign passport will state that, for instance, they were born in Johannesburg, South Africa. The Reserve Bank will then see them as a resident temporarily abroad, even though they don't have any South African identification anymore. And that's normally where we come in and assist those people externalizing funds, or if they want to invest back into South Africa, wanting to buy a property here. It is very important that that is done correctly. So there's various means and ways of then assisting those clients that are seen by the Reserve Bank as temporarily abroad, even if they left as minors. Thanks.
Matthijs, very good comment. And the important part is that we did expect this round of updates to actually include a non-resident definition of any minor that left South Africa, albeit born in South Africa, but left South Africa before the age of 16 or 18. So there was this debate between the tax authorities and exchange control, what should be the age?
Yeah.
The Reserve Bank wants to go the Home Affairs route, which is 16. And just for those guys who can remember that, old enough like me, that's when we started our national service. You had to get an ID book. However, the tax man says that person up to 18 can't get a single discretionary allowance. So for SARS position, that person doesn't need a tax number until 18. So that's an interesting, and that definition is probably pending somewhere in the background. And we expect that to have that. But at the moment, Matthijs, it's problematic. But as you say, that is how.
Yeah, those
are dealing
those peoples we were referring to, the residents temporarily abroad, those are the people that were not listed on their parents' application when they did the old formal immigration via the Reserve Bank. So that's basically a person that hasn't got any documents to prove their immigration, or South African, they don't necessarily have any South African ID or a passport.
Just to interrupt, sorry, Hugo and Matthijs, can you see there are basically it's one question in the Q&A block? Do you want to?
I can't see it because I'm doing the share screen, so mine is on full screen. Welcome to read it to me. Read it to me, but I intended doing it after the break. But read it for me at the moment.
Okay,
during the lecture to read it so that we keep abreast of the questions.
All right. So the first, it's one, basically one, but let me just read that. If you become a non-resident for tax purpose, are you still able to retain your SA citizenship?
Oh, absolutely.
One has got nothing to do with the other.
Okay. Then a slightly more longer one. It's a beneficiary living overseas for the last 20 odd years is receiving an inheritance less than 10 million rand and was asked by her bank to provide a tax clearance certificate. Her tax number is inactive as there is no e-filing profile. So I've tried contacting manual compliance department of SARS, but to date have not received feedback. Does the beneficiary really need the tax compliance certificate?
Can I defer the answer there? And I'll give you a quick hint, is that the update that came through on the 19th partly addresses this, but it does not resolve the problem of people that left South Africa and has not notified SARS that they are tax non-resident. So I will make sure that I deal with it when I get to that slide. It is a very pertinent question. It is just changed. So in going back to the bank, in this client's case, they can maybe say, look at Circular 14, the one that's on the screen, and do they still need a tax clearance certificate? Because the old manual did not state clearly that there's a manual process. So SARS had on their webpage a manual process, but the bank now, the Reserve Bank, in their manual, for the first time acknowledges that there's a thing called a manual tax clearance for international transfer. But the problem we have is those people below 10 million. So the Reserve Bank says, if the value of your distribution capital from the trust and Mortis Causa Trust or from an estate is more than 10 million, you have to go via SARS, and SARS must answer you. But sadly, the gray area where there's no clarity and we have no process at this stage to prove to a bank to their satisfaction that a person is non-resident is the inheritance below 10 million. But I'll go through that in detail. Okay.
Well, I don't know if the other one will also then relate to this, but it's what if an individual is living overseas with the intention to become a citizen of the foreign country, but the process takes a few years to finalize? Does this mean that the individual will not be able to apply for non-residency status until they have become a citizen of the foreign country? Then
no. So they as long as they can qualify for the treaty benefit, okay, and the treaty benefit, for example, in England, you can claim the treaty benefit after living there for 45 days, legal or illegal. So your passport or your visa, again, has no significance. In the US, it's 2 tax years to 3 tax years. Once you have been in the US 183 days, tax count, and that means in the first year of arrival, you count 1/6 of your days. In the second year, 1/3 of your days. And in the third year, all of the days with a minimum of 90 days. If you then hit 183 days on that count, that's their physical presence test. So someone who goes to America and goes there on a 10-year visa and goes in for 4 months, leave America and go back for 4 months, totally legal, they have now spent 8 months of a tax year in the US, and then they are US tax resident, and then they can avail to the tax treaty and become tax non-resident, irrespective of whether they hold a green card, a non-immigration visa, or a passport. So no, the Reserve Bank will then, based on the treaty outcome and the letter from SARS, allow you to tax immigrate. That person that is in the process of obtaining, I have had great success in having that person declared ordinarily no longer tax resident, because the test in South Africa is intention and ability. If you clearly have the intention and your ability comes with time, SARS now accepts that you can say, in terms of the treaty, I'm already tax non-resident, but I'm saying to you that within 2 years, attached is my letter from the attorney, saying that within 2 years, I will qualify for dual nationality. So therefore, treat me as ordinarily no longer resident. So you can do that without second passport. Okay, let's go on. So yes. Matthijs, it is quite disappointing, I don't know what your opinion is that we have this process of immigration at Reserve Bank based on SARS process of cessation of tax residency. But the word immigrant is not defined in the Income Tax Act and not defined in the Reserve Bank manual.
Yeah, it is quite an issue, but there you go. That's the cards we've been dealt with. We must treat it accordingly.
And that's how you and I make our money, hey? So we officially won't complain, but I need to highlight to everybody that the word immigrant is not defined. Immigrant, that's someone coming in. So how to remember that is that immigrants with an E, that's exit, leaving. Immigrant is coming in, although it's IM, but that's an incoming person. That means a natural person who immigrated from countries outside the CMA with the firm intention of taking up or having taken up permanent residency. So remember, I just mentioned that firm intention to become a dual national. The Reserve Bank acknowledges this as well, that there are people who come to South Africa with the intention of becoming permanent residents, but they're not yet a permanent resident. Typical example, and look at interpretation note 3 and I think 4 of the South African Revenue Service. If you are coming into South Africa to marry a South African spouse, you qualify for a spousal visa, and therefore you will eventually get permanent residency, but it can take 2 to 4 years. So your first spousal visa is one that is your spousal visa. You can stay for longer than 90 days, but you're not allowed to employ. Then you have to convert it and get employment rights, and then you have to convert it to permanent residency permit. But those people will immediately be treated as resident and immigrant because the intention is to come and live with a South African spouse. And then non-resident means a person whose normal place of residence, domicile, and registration is outside the CMA. No reference to tax immigration. The reason for that is a born American that owns a property in the Atlantic seaboard in Cape Town. They have a South African asset or link, but they are not South African. They're not exchange control resident, they're not home affairs resident, and they are not tax resident.
Although they might have a tax number.
And might have a tax number. But that makes them a taxpayer, not a tax resident. Very good comment there, Matthijs. So here comes the change. Okay, and that was the question that I said I just wanted to carry forward. So now this is the biggest change, as far as I'm concerned, in the 19th of June update, where that arrow is. But let's start at the top. The concept of immigration has been phased out, 1 March 2021. That's been there. It's been there since then. The distinction between South African resident assets and non-resident assets remains extant. We'll deal with that later. That's how you convert the South African assets to non-resident assets. That's stamping a share certificate as non-resident. Matthijs feels that there they went a little bit backwards, but we'll deal with that a bit later. Authorized dealers, that's banks, may allow the transfer of assets abroad, provided that the private individual has ceased to be a resident for tax purposes. Can you see that's subject 1? Then 2, has obtained a TCS PIN letter in respect of an AIT, approval of international transfer, where the individual is registered on the SARS database. Now, that was never there. It always said had a TCS PIN letter. So we had issues where people had immigration letters that had no assets to take out. And that remains a big issue, is that you may have someone that left so long ago. I can get him a tax letter of non-residency status, but they have no assets in South Africa. So what am I going to transfer out? To do an AIT, I need money in South Africa. And we'll show you later, more than 100,000 Rand before I can get an AIT. So therefore, there is now clarity, but there's still a group of people that are not provided for. Then secondly, it says, or a manual letter of compliance, - international transfer. So you get one letter that's a manual letter of compliance, good standing, and then you get a manual letter for compliance of international transfer. So when a person has received a legacy from a South African and they live abroad, or they are a beneficiary of a South African trust, or they are a beneficiary of, that is Inter Vivos trust, or of a mortis causa testamentary trust, that person needs a manual letter of compliance - international transfer. And that letter will normally state a value as to what is the amount that can be transferred out. And that deals with the asset inherited, not the income flowing from the inheritance. So if you inherited a house, it's the value of the house or the proceeds on selling the house. The interest or rental income, that is freely remittable. We'll get to that later. So very important on that question earlier, you can now go to the bank and say that has changed, okay? But when we get later to the more nitty-gritty detail, okay, there it is still very clear that the Reserve Bank wants that person to have completed the tax residency status, okay? So then in A to B, there's no word or and, okay? So my interpretation is if it's a non-resident, remember the example we had earlier, that person, a non-resident who never lived in South Africa, then I can easily get that person a manual letter of compliance, okay? And for that person, below 10 million Rand makes no difference. However, if that person has a South African link, born in South Africa, South African ID, permanent residency permit, South African ID non-citizen, that person needs to go through point A. So this is very new, but that is my interpretation. And that is how Matthijs and I have experienced this in the recent years. We even had a situation recently, his surname was not Van der Merwe, but I'll use that as an example. His surname is Van der Merwe. He worked for a South African company, so he has a South African pension fund, but he's not spent more than 2 years, 700 days in South Africa in his lifetime of 55 years. He was not even born in South Africa. His father had a South African ID, but he has never had a South African ID. His father has not even registered him in South Africa. To get that pension fund out, Matthijs and I had to go and register the poor man, and we are now busy with an objection because SARS withheld tax on his lump sum. Okay, but back to that question, unfortunately, below 10 million Rand, SARS is not obliged to issue that letter for someone who is tax immigrated. For that person, all you can do is get a letter from SARS, and you'll probably have to have an appointment to get that, where SARS will say over and above the letter, of tax non-residency, they are inactive on the e-file system. Or if you're lucky, you'll have a letter which says you have now been made inactive. But unfortunately, at the moment, and maybe that will change in due course, SARS sends you an email to confirm that your data or static data, the RAV01, has changed. They do not, as in the old days, give you a PDF letter with a signature on. So there is a problem, what I foresee. And then very important is that at the time that your assets are transferred out, whether it is a AIT on the SARS system or a manual AIT, if I can call it that, a manual compliance letter, they then have to do a verification to see that you are tax compliant if the TCS is applicable. And I hope, this is a brand new wording, that obviously people who are not active on the SARS system now no longer needs to get a TCS good standing, because that has been the most frustrating thing to explain to a bank, that someone who's never lived in South Africa, does not have a tax number, will never get a TCS good standing. We had to actually go and register some people, totally unnecessary, to get a TCS. Okay, Matthijs, I'm thinking of that German guy that we just got we're waiting for his immigration letter. If this was out, we didn't need to go through that process. I mean, the poor man. But anyway.
Frustrating.
Maybe more complaints that have now made them see the light. I claim all the credit for myself, but I was very vocal in my complaints. Matthijs, sorry?
No, it's a very frustrating situation.
Just give us the background quickly. So it was a South African company, and he bought the loan account. He's a German, and he bought the loan account from another non-resident and failed to notify the Reserve Bank at the time.
Yes, then, yeah. It was a company that was formed in the 90s, and the funds flow into the country correctly at the time, but obviously nobody kept any records, and they purchased the property, and the property was recently sold, and the proceeds of that transaction now needs to leave South Africa.
It's the loan
Yeah, we made a Reserve Bank application, and the Reserve Bank actually insists that this poor person now registers with SARS.
I get it. And now we can get the manual letter for a non-resident. But anyway, that's the frustrations we have. And now I'm going to focus, and I don't mind if you ask me the background, because in focusing on the changes, I am assuming that you have a basic knowledge or a working knowledge. If there's any reason why you want me to just give you relevance, what part changed, or why did they make this change, pop the question. Matthijs, if you'll watch that, and Danny, if you guys will watch that, because I can't see the questions coming in, and then just interrupt me and I'll answer them.
Danny, you'll have to help me, please.
So Circular 12 and 13 are significant in dealing with the remaining assets, okay, whereas 14 of 25 deals with legacies. Okay. Very important, traveling allowance. That is Circular 9. So if you look at the right-hand side, the number is the circular. So it's 9 of 25, deals with the traveling allowance. So when the traveling allowance, I'm trying to give you some of the old rules. The AD must inform their clients that any unused foreign currency on their return date must be resold within 30 days to another AD. You don't need to give it to the same AD, same bank. So very important. A lot of people think 31st of December, if I haven't spent the money, I must give it back. It's 30 days from your return date. Now, that was problematic for people like me. I travel 5 times a year. Every time I had to do a fresh application, everything that's left, I had to give bank, and you lose and you pay commissions. Now they have a new rule in place. We'll look at that. It says, as an alternative, unused foreign currency, physical cash, travel cards, or SWIFT transfers that were reported as travel money, okay, not reported as foreign investment, into the traveler's foreign currency account at an authorized dealer within 30 days of the traveler's return to South Africa. Now, obviously, I don't use the travel cards, but I know that ABSA has a TravelX card, and I assume because that is issued by a South African authorized dealer, the unspent money on there can just stay in there. But if you have hard cash or traveler's checks if people still use that, it must be converted and banked within 30 days into that foreign currency bank account. Okay. So that is what we call, and we'll later deal with that definition, a client foreign currency account, a CFA account or CFC account. Now, the word CFC has another connotation. It's income tax. And some people call it a FCA, foreign currency account, but FCA in the Reserve Bank terms means foreign capital allowance. So we try to use the word a CFC account or CFA account, client foreign currency, a CFCA account, client foreign currency account, to distinguish it from the other tax terms. Circular 10, not that important, but that's for people doing commodity trading. You can now hedge, okay? And that is very important for people who are buying commodities, corn commodities, maize commodities from the US, and you want to take forward cover because the rand is forever slipping and sliding, okay? And authorized dealers may allow a resident agricultural commodity producer, that's agribusiness companies whose core business is the buying and selling of and trading of raw materials or primary products, as well as the management of commodities from origin through to final customer, okay? And end users with firm commitments to hedge their foreign exposure on foreign commodity exchanges. So that is a very, very small, distinct group of people. But if you have clients like that, please use this facility. It is very extremely important. Okay. Now we're at Circular 11, and now it becomes quite meaty. Borrowing abroad by residents, foreign loans originating from non-resident rand accounts. But before we look at the change, Matthijs, if you'll just give us a background, what is the current rules on non-resident loans to South Africans, being individuals or companies?
Prior approval from the Reserve Bank, before the funds are being sent from abroad, one needs to apply via an authorized dealer, and they can do that within a couple of days on banking level, provided that you fulfill certain requirements. Otherwise, it gets referred to the Reserve Bank, where it will take longer, up to 6 weeks. The bank will then issue those approvals with a specific reference letter, and those loans are recorded on the Reserve Bank's loan system. So prior approval before any foreign loans can be introduced into South Africa to a resident, being an individual or a company.
So, and a trust, a South African trust. So Matthijs, if I'm correct, a foreigner can buy shares, send the money in, no prior approval. But if he's buying shares with a loan account attached to it, or he partly funds his South African company that owns the property in Cape Town through a part loan, part shares, then the loan element must be pre-approved. Is that correct?
Yes, and if it was not done, say for instance, an individual, a non-resident brought the funds into his own name from his account abroad to his account here, and then funded the company, he's going to have difficulty externalizing those funds. Then it is possible to do a regularization application, and that cannot be dealt with on banking level. It must be referred to the Reserve Bank. They will then offer, provided that you've got all of the relevant documentation and proof thereof, they will then issue you with a loan approval.
Okay.
So what makes that important is so that those loans can then be repaid.
Okay. Now, very important. This new change, okay, when you read it, means really nothing. It's like confusing, but I'm going to use a very practical example. Mr. A arrives in South Africa, and he is here on a nomad visa. Okay, so he can live here for 36 months, nothing longer. He cannot convert to a permanent residency permit. Strictly speaking, he must leave. He now feels that he wants to buy a South African property because he's seen the bargain. Okay, so now what to be done? That person on arrival, will later go through the detail behind it, okay, should open a foreign national bank account. So it's a foreign national, not a bank called foreign national. He is a foreign national, she's a foreign national, and they get consent to bank as a local. So they can have a dollar account, or if they're from Europe, a euro account, and then they have a rand account. Okay. That non-resident account can only receive funds, the euro and dollar account, from abroad. The rand account can receive and pay money in South Africa and receive money from abroad. So now that person, remember, they may not be employed in South Africa. We'll get to that detail later. They can now send in their €1,000,000 and let that lie on the non-resident bank account. And 2-3 months later, when they've identified the property, they no longer need to send the money out and then back to the South African company. They can now, on request, so it's an application, it's not an automatic. So again, a loan account subject to approval. Okay. So what they can now do is go to the Reserve Bank, and Matthijs can help you with that application that says, there's my non-resident account. And this could have been someone who immigrated as well. There's my non-resident account. There's euros lying in it. I want to transfer that to my South African company. Can I immediately transfer from that euro account to the bank account of my company, but give me prior approval for the loan account? There is the terms. And normally you have to say the period, the interest rate, and whether it's denominated in euros or in rands. So that is a big solution. The other problem is we have clients who bring money in and they want a dollar loan agreement. But when they put the money in the South African bank of the South African company, that company has only a rand account. Therefore, rands land in South Africa. Now the Reserve Bank says, no, you can't do a loan agreement on dollars because the agreement must be in rands because rands landed in South Africa. Now the better structure would be for that shareholder, open a foreign national or non-resident bank account, bring the money in. At this stage, it's own account to own account, no loan account. And then from that non-resident account, you transfer it to South African bank, the bank account of the South African company or the trust. And that's when Matthijs gets you that prior approval. And as he said, if it's a standard agreement, it's relatively quick. Okay. And a change request, this is what the application, must be submitted by the authorized dealer on the Financial Surveillance Department's reporting system. So what this really says, and Matthijs, correct me if I'm correct, is if the bank approves it, if they have authority to say it meets, it ticks all the boxes, then they just purely report it. Okay. Then they don't need to go and wait 2 weeks for the Reserve Bank to approve. They must just
2 weeks. That's lucky.
Yeah. But the important part here is a change request can now be submitted by the dealer as a reporting system, which means the dealer has the authorized dealer, the bank has the obligation to check and tick that it meets all the things, that it's a written agreement. The currency is determined, the interest rate is determined, the loan repayment terms are there, and the term of the loan. What is the other requirements they have, Matthijs? There's some interest rate, and it cannot be more than 2% of the bank rate in that country.
And also who the lender is. They scrutinize who the lender is. So you normally need to submit all of their KYC.
And that reason why they ask who the lender is, if that lender or the person sending the money into South Africa is a foreign trust, and that trust is funded by South Africans or have South African beneficiaries, that is a loop structure. So that loan account needs to be reported in terms of the loop structure rules. Okay. So nothing has changed there. So that is sad. The loop rules, Circular 1 of 2021, has been subject to so many reviews and so many new drafts, but yet it has not been amended. So as the rule now stands, a loop need not be pre-approved, the share part, but it must be subject to market value, an auditor certificate, and currency must come into the country. And then the second leg, if any part of that loop is a loan account, it must have prior approval. So on a loop structure, the actual shares and transfer can be reported late, but the actual loan funding, if you're buying someone else's loan and you're sending money into South Africa, you need to do that on prior approval, okay? And the Reserve Bank, I don't know why, it's very seldom they put this rationale, but they say the rationale behind the above is to simplify administration process for authorized dealers by reducing the need to submit applications. So that clearly tells us, Matthijs, is that also your interpretation, that now authorized dealers can do this transfer switch from a personal non-resident account to a resident account in a company. Is that also your perception? Now, Circular 12, okay? So that deals with section A1, and we have to now look at a few terminologies. AIT means approval for international transfer. So in April 2023, 24th of April 2023, SARS switched off the FIA process and the TCS for tenders, okay? And then combined everything into TCS good standing and TCS AIT. The Reserve Bank did not recognize that until 19th of June. So that is a major change. So the Reserve Bank, up till the 19th, still forced banks to ask for a TCS, tax immigration clearance, and that no longer exists. So now it's an AIT. And that's now where the problem comes in, because remember earlier, to be non-resident, you need to be tax immigrated, and you must have an AIT on record. And I am sorry, Reserve Bank, to say to you, there are people who left this country who will never need an AIT. And to have them stamped at Reserve Bank level as non-resident is still not correctly addressed. Those profile clients, I know they're in the minority, or I think they are, needs to be addressed. But it's going to be more of a majority, because if you think of a young that is 18 years old, going to varsity, study abroad, not coming back, got his job that side. He didn't even have a bank account when he left South Africa, or if he had, his parents closed it because it was just too costly. So that person has no assets in South Africa. Now we need to get a tax immigration letter, and according to the current J system, bracket J, they also need an AIT. But for that person, I'll never be able to do an AIT because they have no bank, no cash in South Africa. Then TCS means the tax compliance status. TCS, that is where you go to the status check, the SARS compliance check, the top blue bar. The letter that is issued that you are tax non-resident is not a compliance status check, okay? Because a tax compliance status check has a PIN to it. That's how you identify. And you can at any time check the validity of that TCS. Where sadly, the immigration letter as it stands today has no ways where a bank can see if that person remains non-resident. So there's this big gap in the market that people can come back, not notify SARS, and the banks are going to still treat them as exchange control non-resident, where in the meantime, they have become tax resident again. But I have been very vocal about those issues, but nothing has been done about that. So now to the nitty-gritty of Circular 12. So first of all, maybe I must just do the following. I wanted to move the slide and I forgot. Just to explain to you, B2 deals with private individuals, South African companies, international headquarter companies, South African holding companies for African and offshore operations, listed companies, unlisted and financial services sector, technology media companies, South African private equity funds, H is the institutional investors like Old Mutual, Sanlam. Then I doesn't deal with an identity, but it deals with the rules applicable to ADs, the macroprudential limits. Okay. Then J deals with private individuals. So if you get confused reading the manual, just remember in B2, B2B, bracket B, is private individuals. And then you have to skip all of C to J, C to I, and then go back to J, okay? They should have put the private individuals who cease to be tax resident and the legacies and distributions. They should have made that CD so that all the individuals are dealt with first. So it's very confusing because you read B2 and people say, I can't find the rules dealing with individuals who left South Africa. It isn't B2. It is just towards the end because that are recent changes. And the Reserve Bank is known for renumbering, so they're not scared to renumber the manual, but anyway. So we're now at B2, and then A is just general, okay? And the general rule says you cannot export capital, including intellectual property, royalties and things like that, trademarks, And if you get permission to transfer any assets or cash, the first 10 million is a SARS process, and everything above 10 million is both SARS and the Reserve Bank. Then B2B deals with private individuals resident in South Africa. Now remember, that's also the person that is temporarily non-resident. So that's people who go and live like myself, 6 months a year in Dubai, but I cannot, and I'm actually speaking to you from Dubai, but I cannot tax immigrate. So I am a South African tax resident and exchange control resident temporarily abroad. So ADs may allow the transfer as a foreign capital allowance. Okay, now that's the FCA via an AIT. So this is the part they put in, because in the past, the ADs always linked FCA, foreign capital allowance, with the old tax term, foreign investment allowance. So banks kept on saying, I want an FIA, and then FIA was switched off 24th of April, 2023. So now the Reserve Bank manual reads correctly. The foreign capital allowance, the FCA, that's 10 million, must go via an AIT, up to 10 million per calendar year per individual, who is a taxpayer in good standing and is 18 years or older, for investment purposes. Remember, the single discretionary allowance can be for other purposes, but everything above is for investment purposes. There's still an old rule that says you can make that money now available to another South African, provided you have done tax compliance, which means you have an interest rate between you and that person, Section 7(8) of the Income Tax Act. Or if you donated it, you've paid the donations tax in South Africa. So it's a pre-legacy. Then the so-called CFC accounts, and that's defined at the top. Okay, a CFC is a client foreign currency account, also known as a non-resident account. Or just remember, me as a South African who earn foreign currency, I can also have a CFC account. So Matthijs has opened me a dollar account with a bank in South Africa. And as a resident, I'm now entitled to that CFC account. And I've been for many years, but now the rules have just been clarified. So that CFC account is totally legal. They can open it for me. The AD may allow withdrawals from this account through the use of any authorized banking product. So if I want to put money into that CFC account, I have two ways. I can either use my SDA or I can use the AIT transfer. The minute it's in that bank account, it is now clear. I can, if you're an F&B client and you have a global account, that is the so-called CFC account. It's not the Channel Island one, because that's not on a South African bank platform. It's owned by a South African bank, but it's a foreign bank. But the F&B global account is a South African CFC account. You can, from that account, now transfer abroad. They cannot stop you and say, now they want an AIT, okay? Because to get the money into that account, you need an AIT. What makes it also now possible is that I can now, the money I earn in Dubai, bank into that dollar account. I don't need to go in rands until I need the rands. And then when I want that rands, that dollars back in the UAE, then I can send it out without a tax clearance, because there's the in-out principle. When I've earned foreign currency while physically abroad, or I inherit it from someone else, as long as it stays in the foreign currency, I can take it in and out of a South African bank system. But if Matthijs, you must quickly help me that I just explained correctly. If I brought $100,000 in, and I get for that 100,000 years back, I got a million rand, okay, 10 to 1. Now I can, on the in-out principle, take out $1 million rands. And the fact that it's now not even $10,000, it's my bad luck. So foreign earned income, the in-out principle for rands is always the rand value that was banked. You have no protection against the devaluation of the rand. Good. And I can hold it in that account with any AD. So even if I took the money out as an AIT through ABSA, I can bring it back and put it in an F&B global account. Okay, so there I'm saying this is complex new rules, And I expect the banks to give you a hard time. But welcome, that is what Matthijs is for. That is his type of service that he provides. There's going to be one or two fights. I can see Matthijs using very big French words again. But the most important part is that CFC account is now freely remittable abroad, because you need the AIT before you go into that. Okay. But the bank can ask for a TCS PIN of good standing. Okay. So it's very important that you make sure that your clients who are living abroad and have not ceased tax residency, that they correctly file tax returns, declare their foreign earned income, claim the 1.25 million exemption, and have a TCS good standing. Now, on the app, I don't know, and this is so brand new, I couldn't test it. I do not have an F&B Global account, so maybe theirs are already correct. I have a Discovery one, and I tried to transfer from the Discovery dollar account to just the Discovery Euro account. And quite interesting is this app immediately said it is reported as SDA, which I understand because on their system, I've not gone over R1 million. So I couldn't test the system. When will the system, and indeed, will the system ask me for a TCS good standing, or will the system allow me to transfer, because it says that you can use an authorized bank product? At what stage is the bank going to ask me the TCS good standing? When I want to do the online transaction, or a week later? I don't know. And it would be interesting to have your feedback. Then private individuals who are tax resident in South Africa and do not have a tax reference number, wait for it, it should have been in red, will have to register with SARS.
I don't understand that.
If you want a dollar account in South Africa, you can now have it, but you need a tax number. If you want to send your single discretionary allowance, and this is now my interpretation, okay, and Matthijs and I didn't even have time to discuss this yet. If I have a single discretion allowance that I want to take out, the 1 million, the manual does not say you have to have a tax number, okay? Then, strictly speaking, you can send from a South African bank account to an account in Dubai. Certain banks will ask a tax number, but they actually need to only check that you're 18 years or older. But the minute you want to take that R1 million, like I wanted to do, into a Discovery account on the South African bank, I now need a tax number. But obviously, in my case, the example I did this morning, they have my tax number. It came up and it said I have to tick a little box to say, I am aware that they will report this transaction to SARS using my tax reference number. So it's quite interesting. And it's sad, but it's how it's going to work. If you want to send money out, you don't need a tax number. If you want to keep it in South Africa on a South African banking platform, they want a tax number. Okay, Matthijs, can you see the fights coming up?
Yeah. And especially, perhaps worth mentioning that for those people that don't have tax numbers, since last year, we see with the third-party data being reported that those tax numbers are created. And remember, we had that client that was on the foreign passport that got a tax number on the foreign passport. That passport expired, and so the banks created him a new tax number. And then he went online to create a third tax number.
Yeah, so Matthijs, just on that topic, I had a SMS from a debt collector yesterday saying that I owe money to SARS and I've been handed over. So and they gave me a WhatsApp number, and I sent them a message this morning, and I said, what's this? I have a good standing. I don't owe you any money. Then they said to me, no, this is the tax number. And I said, okay, that's not my tax number. Give me an ID number, because being a tax practitioner, I obviously have lots of clients. So then they gave me the ID number, and I could trace that client to my system, e-file system. And that's not that person's tax number. So quite interesting, Matthijs, what I think has happened here is that the tax number we have in our system for that person was created when they were an immigrant. So they then did it on a passport. And Lucia, that we use to change the SARS security details, she has recently updated that person's profile to the ID number. Okay, so now SARS has the ID number. But somewhere in between, before Lucia and them did that 6 weeks ago, a bank where he presented his ID number has now done a third-party registration with SARS. And now there's 2 tax numbers on the same ID number. And I tried to call SARS. I still don't know how to resolve it. I'll probably go back to our service provider, Lucia, and say, Lucia, please help. But it is also very important to understand that these third-party number creations or created is going to cause a nightmare for a few South Africans. But okay, now I'm still with Circular 12. And what I did is every page, I try and on the yellow on the top left, give you now what the topic is. So previously it was just the general rules, okay? Now we're going into the meaty part. So an individual can now also have a loop transaction. How they're going to record this at the stock exchange, I don't know. But a South African with authorized foreign assets. Now, that is me who earned foreign money. It is someone who's taken his R1 million single discretionary out, someone who took his 10 million AIT out, and someone who inherited money. Those are all people with authorized foreign assets. If you took it out as a traveling allowance and you forgot to bank it, it's not authorized, okay? So very clearly, those with authorized foreign assets may invest in South Africa provided that various African assets are acquired through an offshore structure, the investment is reported to an AD as and when the transaction is finalized. Can you see it's when the transaction is finalized, as well as the submission of an annual progress report. So they do not state here specifically on the loan account, but in the circular 1 of 21, they do refer to the loan account. Okay. Now, in the background to this, SARS also now allows a South African to invest in listed shares, use your foreign assets, and have that share registered as a loop structure, but it's actually in your own name. So how the poor stockbroker is going to distinguish between what is your assets, stock exchange shares bought from South African rands versus your stock exchange shares bought from foreign earnings, I don't know. But they need to do it because the shares that you bought from your authorized assets, the dividends on those shares, when they are loop reported, it's a non-resident asset and the dividends can go out. But when it's bought from South African rands, it cannot go out. So if it's, for example, a dual listed share, rather invest in London, go through London. But if it's a share that's only listed on the South African Stock Exchange and you want to use your foreign assets, foreign currency, then I foresee a bit of a complication. But strictly speaking, it's now allowed, but it's reported as an offshore structure, and meanwhile it's you in person. Then an AD, authorized dealer, has to view an independent auditor's written confirmation or suitable documentary evidence verifying that such transaction is concluded on arm's length. So up till now, it's always been an independent auditor. Not all companies are audited. Trusts are not audited. So if that trust holds a fixed property, you can now present an valuation of that property and do a net asset value calculation. Again, upon completion, the AD has to list with the Reserve Bank the name of the South African target investment company, either that JSE shares or the unlisted company, the family business, if applicable, and the date of the acquisition. So you're backdating it, as well as the actual foreign currency amount introduced, including transaction reference number. I put that in yellow, and the practical take home is if your clients are doing this, remember the previous approvals that is now allowed. Open for them. Let Matthijs help you open a non-resident account. The money must come into South Africa in a foreign currency. If they do send rands to South Africa, the loop structure is not legal. And Matthijs and I get so frustrated because in Dubai, for example, if you go onto the app and you send money to South Africa, they convert that dirhams. Yeah, because there's only one bank in South Africa at the moment, and I think Matthijs is correct. There's only one bank that will accept dirhams.
It's not, it's more than one.
Yeah. So therefore, the banks this side know they can't send dirhams to South Africa. But the Dubai dirham is actually fixed linked to the dollar. So they can do the conversion in Dubai and then send dollars. Then it's easy. But for loop structures, please, this is your take home for today. It now clearly stated it must be actual foreign currency introduced into South Africa. Matthijs, tell them the story. I just want a sip of water about that beautiful Section 42 structure done by an audit firm, and they forgot to get Reserve Bank approval, and they didn't bring money into the country.
Oh, yes, it was a beautiful tax structure being done without taking into account any of the exchange control provisions. So once the transaction was finalized, the clients obviously sent that to the Reserve Bank for approval, and it got denied. And that's when the client, made contact with us to assist. There's no way in fixing that transaction. You have to undo it and redo it the correct route. And it's costing the poor client lots of money.
And tax money, because remember, Section 42 is you issue shares in lieu of an asset exchanged. So your payment is in shares. And the Reserve Bank is now very clear. It was policy, now it's in the authorized manual, AD manual. They want foreign currency to come into the country to do a permissible loop. That means, in short, my dear chartered accountant and tax clever colleagues, no more Section 42 loops. No more Section 42 loops. You'll have to make your client pay the capital gains tax, and the money must come into South Africa. Whether it's fair or unfair, I'm not going to debate that. All I'm saying to you, that is now the message. So that highlight is your take-home 2 for the day. Loop structures must be a cash transaction. And very important, it's been there for a long time, I'm just adding it, existing unauthorized loops, like this client that Matthijs now mentioned, who did not bring into South Africa the cash. That's an unauthorized loop structure. And on authorized loop structure where the 40% shareholding threshold was exceeded, that was the old rule, must still be regularized with FinServ, which means it's an application. You can't just get the bank to report it. They will not pass the test. Okay, so very important. I'm now going to the next slide, and at the top left, I'm now dealing with people taking more than 10 million rand out of South Africa. So now the manual is very clear. In the past, it was just saying that a application for more than 10 million will go through more scrutiny. Now it says FinServ will consider the application. So an AD does not have the power to approve a transfer more than 10 million on AIT. And Matthijs, this now explains those processes, which I think we've seen 4 to 6 weeks, if not longer, that it needs to go to the authorized dealer. The bank cannot decide on that. Okay. And they've also now added, you can do it via the AIT process. Okay. So interesting, yeah, there's no provision for a manual compliance letter. It must be the AIT. And you must invest in different asset classes. Now, interesting, how they're going to monitor that, I don't really know, because you transfer cash out and then the assets are bought on the other side. So we can't really provide to Taxman or the Reserve Bank proof of the fact of the different asset classes. I think, Matthijs, maybe just in your application, you'll say that they intend to buy shares or they intend to buy property or whatever the intention is, but they can't check that on the date of the application because the application predates the actual physical transfer of cash. Such investments, if approved, could be facilitated via a foreign, domiciled, and registered trust. So you can therefore indeed now take that money to a foreign, domiciled, and registered trust. You cannot take it to a South African trust. What is not written there, but it comes from Matthijs Circular 6 of 2024, which says a South African trust can no longer have foreign assets. Okay. So foreign investments cannot be placed in a South African trust, but it can be placed in a foreign domiciled trust. This dispensation would also apply to private individuals who have existing authorized funds. Okay, so you can take your old money, your new money, combine it together and put it into a foreign trust. TCS PIN will be issued to the taxpayer that will contain the tax number and the TCS PIN. That's how you'd identify a TCS letter versus a flat letter. There's a PIN that you can always check on the SARS webpage. The AD must use the TCS PIN to verify the taxpayer's compliance status. So at the time, it's not just the AIT approval. They must also check the compliance status. So remember, those AITs are valid for 12 calendar months. You can only take out 10 million per calendar year. So if you have not used everything in last calendar year and you carry it forward, you can still use the same AIT, provided you have not exceeded the value of the AIT. But in the next calendar year, the AD must go back to SARS and check that you are still tax compliant. Now, remember, we don't have tax filing obligations normally around January, except our provisional taxpayers. And those are the ones who are going to take the 10 millions out. So this is the message we have to give our taxpayers that are provisional taxpayers. Even if you had an AIT in November and your provisional tax return was not yet due, comes 25th of January, and you have not filed your provisional tax return for February 2025, your AIT is now useless. Totally, totally useless, and they make it very clear. Then the taxpayer must go to SARS to resolve it. You cannot fight with the authorized dealer. Authorized dealer will just tell you you're not compliant. We don't know what the reason is. SARS is not going to break confidentiality. SARS is just telling us there's a problem, and it's for you, taxpayer, to go back, or applicant to go back to the taxman. Okay? And then AD should not transfer any amount if the resident's tax compliance status is indicated as non-compliance, okay, or non-compliant. Okay, so this is a new process, and I think it's going to burn us comes January of 26, because all these provisional taxpayers that are continuously late, we have played a little game of getting an AIT the minute they have filed, even late, the 24 tax return, because remember, the minute you filed it, even if you haven't answered the queries, you can do an AIT, because for the next 60 days, your client is compliant. But now, if you don't submit your documents that SARS asked, the verification detail, or you haven't submitted by end of January, your February 2025 tax return, you're now going into a new tax year, and once a year, and at the date of transfer, an authorized dealer must check your compliance status. Okay. Now, Circular 12 deals with dual listed shares. We're not yet at unlisted shares. That pain is still coming. It's waiting for us. But here's the unlisted rule, the listed rules. Private individuals may, as part of their single discretionary allowance, the 1 million, or the FCA, that's the 10 million, the AIT, export multi-listed domestic securities to a foreign security register in a jurisdiction where such securities are listed, subject to tax compliance, which means you must be tax compliant in South Africa, and reporting it via the Central Security Depository Participant platform. At the top, I have the definition for you, in conjunction with an AD. So some ADs, like F&B, have their own stockbroker. They can do it all at once for you. But very important is that if that share is transferred, the beauty is that you do not trigger capital gains tax. So if you wanted to ask me why would people want to do that, obviously it's rand hedging. But secondly, it is now that you can then keep that share and you do not trigger capital gains tax. Because remember, if you wanted to move shares on a dual listed company, was it Process, Matthijs, the Naspers one? You had to sell the shares this side, transfer the R1 million out, and buy the shares that side again. So you were at risk of a bed and breakfast deal. You had to pay capital gains tax, and if you made a loss, you couldn't claim the loss. So now the Reserve Bank allows you to move those shares out. The confirmation letter And the approval is subject to the full names and identity numbers of the applicant, the person who did the SARS application, the name of the company that issued the securities that are to be exported, as well as the number of the securities, the share numbers, and the market value thereof. We have found, although that this requirement has not changed, but in practice, because this was partly possible in the past, they also ask who is the who runs the share register, okay? Because in South Africa, typically it would be CompuServe, in London it would be someone else. So we see the Reserve Bank in the application also ask you to list who is the central deposit participant or registration, or who administers the share register on the other side. Then it says domicilium and the name of the target foreign register on which the securities are listed. And that is, I think, where they, although the foreign register would still be processed, they want to know who runs that, and you'll need to give them, and that domicile is the address of the person in Holland that runs that, okay? Private individuals who export securities with a market value of more than 10 million are subject to a more stringent verification process by SARS, as well as an approval process, and now very important, from the FinServ. The bank, the AD, can't do it. Okay, so there's the big chunk of Circular 12, and this is the slide that I showed you earlier, just to show you in context. B2B is private individuals, and then you have to jump down to J, that's the private individuals that cease to be tax resident, and K is the legacies and distributions from deceased estates and testamentary trust. We'll get to the last a little bit later, because there's not that many changes in that one, but they are certain rules that becomes extremely important.
Hugo, I know we'll get to the allowances later. I just wanted to mention that a person is not limited to the 1 million single discretionary allowance, and then the 10 million allowance you can take out with an AIT. For the 1 million, there's no approval required. For the 10 million, firstly, SARS approval. And if you want to take an excess of that, you firstly go to SARS and then to the Reserve Bank, meaning that there's actually not a real limit on the amount of funds you can take out. I often hear people, oh, I can only do 10 million. No, that's not true.
Okay. Right. Now, Matthijs, we're now at B4. Remember? Let me quickly show. That was B.2. We're now at B4, okay? Now we're dealing with residents temporarily abroad. So myself, who are temporary abroad, I have not tax immigrated, may avail to the 1 million single discretionary allowance and the 10 million, what Matthijs now mentioned. But the minute you have tax immigrated or cease to be a South African tax resident, that is now capped. I may use my local debit and credit card, and I'm going to later deal with the existing rules. This is just the changes within the overall single discretionary allowance limit of 1 million per applicant per calendar year. The annual limit of the 1 million single discretionary allowance and the 10 million foreign capital allowances may not be exceeded for the person's temporary non-resident. Okay, so unfortunately, you can't argue that living expenses is too high or something like that. It is just not possible. So if you can't live within that 1 million, you'll then have to do the 10 million process. The travel allowance may also be transferred abroad to the traveler's own bank account. It's always been like that, and or a spouse account, but not the account of a third party. Okay, the exception we'll get to now, that's students. But for example, Matthijs has often in the past transferred me my travel allowance. Now I'm outside, I'm already outside South Africa. Okay, then he transfers me that amount from my South African bank account to my Dubai bank account. And that's always been allowed. Okay, but they've now added to a spouse's account. Now, interesting, tax law, spouse is someone of intent. But the Reserve Bank, I think it's still someone who's legally married. Then here comes the exception.
The banks normally ask for a marriage certificate.
Do they ask? Yeah. Okay.
I've seen that in the past, that they do ask for it, yes.
Yeah, because they did not accept the spousal definition as in the income tax, the Tax Administration Act. So minors traveling with their parents may have their travel allowance transferred to the parent's bank account. So I don't have children, but if I had, could be. But remember, you can't transfer to a third party. And the following rule has been there, no change. students under the age of 18, also qualifying for a study allowance to pay for the cost associated with their studies abroad, as well as their traveling allowance of 200,000 per calendar year, can be sent out. So if the student is below 18, so that is really what takes to be scholars. You know, if you have a father who has to pay maintenance for his child living in England, okay, then he can send 200,000 as that child's travel allowance, plus he can pay the school fees in England to a third party. Not a big gap, but there is some, okay? Then credit and debit cards may be used to avail up to 100% of the authorized, prescribed, that's the SDA 1 million, or the remaining traveling allowance. And Matthijs and I have seen a few people burn their fingers with this because they buy foreign traveling tickets. So it's an etiquette not starting in South Africa. And they transfer cash bank to bank because it's now allowed. And then they think they can still spend $1 million on the credit card. And because of the ID numbers, we pick it, the Reserve Bank picks that up.
And also it's different banks they normally use. So the Reserve Bank only picks it up after the fact.
All right. Okay. Then B2, temporary abroad. Residents temporary abroad may receive pension and retirement annuities, as mentioned in B3A, and I'll explain that later, of the AD manual, as well as monetary gifts and loans, as mentioned in A. That monetary gifts and loans, remember, that's single discretionary allowance. You can gift it or loan it to another South African living temporarily abroad or permanently abroad. But no other foreign currency may be availed to without specific prior approval, the 10 million. So B3A says transfers of income other than transfers from pension and retirement annuities, okay, living annuities, okay, excluding but not the lump sum, may be transferred abroad. Now, Matthijs and I have daily fights with the ADs. They don't understand it. It's very bad English, okay? They are insisting on an AIT for a living annuity being transferred to a retiree living in Australia who has no residency permit in Australia. They just spend a lot of time with their children. Then B4A says authorized dealers may allow resident individuals to transfer monetary gifts and loans within that limit of 1 million to a non-resident individual, as well as individuals who are temporary abroad. So if my 1 million runs out, I can legally ask a parent or a brother to send me their 1 million, but make sure there's a loan agreement because otherwise it's a donation. So very, very important is that there are legal ways that the manual now allows, in the spirit of the manual, that you can take it out of South Africa. You can use other people's allowances, but it must be in place. But quite interesting is that, Matthijs, it was about 18 months, if I remember correctly, where all those arbitrage, crypto arbitrage people that were borrowing money from each other and using other people's single discretionary allowance, they blocked that account, and the excuse was, or the reason was, that it was against the spirit of the exchange control manual. Most of those monies was released in the meantime, but quite interesting, about 4 Fridays back, Standard Bank, based on that, got a Pretoria High Court ruling to say that crypto is not money and therefore not subject to exchange control. And very quickly, Treasury and the Reserve Bank went and appealed against that ruling. So if you read that, yes, Standard Bank won the case, but because the appeal was noted, no one can actually act on that ruling, because now it's going, I think, probably, Matthijs, directly to Constitutional Court, or is there certainty? Are they going to appeals court, or do you think it will probably
the appeals court first? I highly doubt whether they'll go to the Constitutional Court first. It is possible in some instances, but no, I think they're definitely going to Bloem first.
Okay, and then Matthijs and I have one client like this. It's not often that you have such rich clients that take their yachts abroad, but residents on application may be allowed to export an ocean-going yacht, luxury vehicles, or aircraft on a temporary basis, provided that the item will be returned to South Africa within 24 months, and the insured value thereof does not exceed the insured value, maritime law, okay, 10 million. And remember, maritime law is replacement cost. Market value, not replacement cost. Your home insurance, you insure at replacement cost. Maritime law is at market value. So the market value may not exceed 10 million. Now, it's quite interesting. For aircraft, you probably will very seldom see an application because the aircraft regularly flies back into South Africa. But yachts, because it takes so long to cross oceans, they will probably be outside South Africa for more than 24 months. And Matthijs, this client has sent us that application. He's done it 4 times. It's been 8 years, nearly 10 years, that his yacht is outside South Africa. So we are now going to take a break. Before we take the break, is there questions, Danny, that you want to pose to me?
Yeah, there's quite a lot of questions. I didn't want to interrupt your flow, so there was quite a few. All right, let me try get through where they all are. Okay, so the first one, did you want to touch on that one about the 10-year that we mentioned earlier with the manual compliance? We covered
I've
that
touched on it. I've answered that. So in short,
all right.
People up to 10 million cannot get that letter from SARS. SARS is not obliged to give it. So if you do not have a tax immigration letter, my interpretation is you'll have to go and do a tax immigration. Sorry.
Okay. Next, taxpayers applied for non-residence from SARS and received approval from SARS as a non-resident. A local trust awarded some funds to the taxpayer, and the banks did not accept that the taxpayer had immigrated and insisted that the AIT process be embarked upon again, and that the tax clearance states that the taxpayer has immigrated.
Yeah, that's correct. That is now I think a little bit of a backward move, but that is now in Circular 12, and that is the J part. Let me quickly see if I can go back to that. There it is. To be tax non-resident at the Reserve Bank, you must have a cease to be tax resident letter, plus you must obtain a TCS PIN letter in respect of an AIT or a manual letter. So if that person is no longer active on the SARS system, you can go for a manual letter, but SARS is not obliged to issue it for amounts below 10 million. So that's those clients on the trusts, I don't know how to overcome it. If it's an inheritance, go and register, get the TCS, get the AIT, transfer the money. But the person for the trust must get a good standing, the individual must get a good standing, and the individual, the immigrant, must get an AIT. It is our understanding that an old AIT will carry you forever, okay? You just have to be good standing. But Matthijs, there must be at least one AIT, and that AIT must be obtained as a non-resident. So the AIT, Matthijs, must read as a non-resident, correct?
Yeah, you go, but that opens up another can of worms. Remember, the banks think that an AIT is where you place all of your remaining assets on record, which is not the case. It's only permission to take out some of your remaining assets. So I don't think it's going to help a lot.
Yep. So yeah, for that person, we still foresee a problem, Danny.
All right. So the next thing is, what happens if a property is purchased in their own name and not a company? Not too sure. This was
no. That's okay. So now what happens is to become a non-resident asset, and that has not been clarified in the new manual. But if you look at what it needs to be done for shares, you need to do an AIT for the value of that property. Then the property title deed can be stamped. They don't really physically stamp it, but the property is then recorded as a non-resident asset. Now, just remember, on properties, there's no real benefit on doing that, because the capital gains tax is not paid when you leave, but the capital gains tax is payable as a withholding tax when you sell. So it's probably the reason why they didn't cover that. Sorry, Matthijs?
At 7.5%, and in order to get those funds out, you could use the in and out principle. You don't need the AIT.
all right. The next one, local trust has funds offshore and had it approved through VDP. Can the local trust continue holding the funds, or must the funds be transferred to a foreign trust?
No, it must be brought back to South Africa, Circular 6 of 2024, or you can do a new application for permission to retain it there. I've had one where you won't believe the conundrum they caused. The property can stay, and we only need to bring the money back when the property is sold, but the bank account had to be closed. Now, how do you get the tenant in London to pay you rent in South Africa. So yeah, that one is a nightmare, but strictly speaking, you have to do a new application and expect Saab, FinServ, to say, bring the money back. If it's listed shares, they're just going to say, sell it, bring it back to South Africa. The other option is that you can ask for that to be distributed to a beneficiary. Then they're going to ask you, and I've never done that, but I've told that it works. Then you go to the taxman, you get evidence that the capital gains tax was paid by the South African trust or by the beneficiary, if that beneficiary is tax resident in South Africa. And then the Reserve Bank will allow you to keep the money abroad in the name of the beneficiary, but it cannot be retained. They have this mental block against a foreign trust. And that is the reason. So a lot of people say, it's very strange that they now allow a South African trust to distribute to a foreign trust, okay? And that's the reason why they do it, because the Reserve Bank does not want South African trusts to own foreign assets.
Would you need to obtain approval from the Reserve Bank if a South African resident brings funds from foreign trust source to a local trust and reflects it as a foreign loan? And is the South African resident a trustee of both trusts?
Yep. So all the things that they've mentioned is red herrings. The principle is any loan by a non-resident, and that foreign trust is a non-resident, okay, to a South African entity, be it a trust or a South African company, needs to be approved before the money comes in. Is that correct, Matthijs?
Yes, that's right.
So the answer is clear. There's prior approval required.
Okay. Does the 1.25 million exemption still apply if living in the foreign country for the last 6 years, paying foreign tax on any income earned in that country? Would the DTA rules override the 1.25 exemption?
No, the DTA will only override if the person is tax immigrated. If he has not tax immigrated, there's no override in the treaty. There's just an administrative process governed. So, for example, I'm going to use England. If you don't tax immigrate, you first pay the tax in England, and then coming back to South Africa, you can either use the treaty or Section 6 quat, and then you claim the 1.25 million exemption, it will be granted. And then the amounts in excess of 1.25 million, you can claim the UK tax on the excess as a deduction in South Africa, 6 quat or the treaty. Will I use treaty or will I use 6 quat? I will use 6 quat if the excess, the tax paid in England is more than in South Africa. I have yet to see where that happens because most of the foreign countries have a tax rate lower than ours. But if, for example, it is at just over 1.25 million, so it's like 1.35 million, then you can, and I've seen situations where it's better to use 6 quat, because 6 quat says for the next 6 years, I think it's in total 7 years, that you can carry forward a foreign tax, an FTC, foreign tax credit, where in a tax treaty, you can only claim the foreign tax credit paid in that relevant South African tax year. So the fact that you've been out 6 years does not exempt you or lift the 1.25 million. What lifts the 1.25 million is to tax immigrate and get a letter from SARS to say you have ceased to be a tax resident.
What if there is no income earned in South Africa for the foreign resident?
Still tax immigrate. It's now a requirement to do it. And if there's no more assets in South Africa, you can have yourself deregistered, made inactive. But if you have a bank account, a property, you're a trust beneficiary, have a South African life insurance or retirement fund, you can deactivate your number or become inactive. But as Matthijs mentioned earlier, that third-party registration, auto-registration, is going to create a registration in any event. So my advice is, if you want to be inactive on the SARS system, you must make sure that you have no financial footprint. And I say no financial footprint in South Africa. The only thing that you may have then in South Africa is you are a possible legatee or named beneficiary in your mom or dad's will. But for the rest, please do not make your number inactive, because you will need a TCS good standing to get your money out. And as we've seen, if the amount is below 10 million, we have that uncertainty. Then even if you're inactive, SARS is not going to give you a manual letter and you are stuck If the Reserve Bank or the AD is very difficult, we'll be forced to do a TCS AIT.
One last one. Transfers from countries which have no proper financial system, such as Zimbabwe, is there exemption?
No. Sadly. So the only solution there, and I know South Africans are bringing dollars and things over the border. It is extremely difficult to cash that in at the, strictly speaking, within 30 days, Matthijs. You must give it to an authorized dealer. That's in regulation 6 and 7. That's in the old regulation that comes from 1949. It's never been changed, and there is no exemption. There is, however, a tax exemption. If you have income that is stuck in another country and you can't get it out, then you can apply to SARS for deferment of your tax liability. But by strict rules, you're still taxed on it, but you don't need to pay the tax to the tax man, but it's an application process.
All right, that's all the questions I have on so far at the moment. All right, so should we have now a 10-minute break and start again?
At
How
10
long do
to.
you? Yes,
Yeah.
at 10 to.
Okay.
Perfect.
Thanks, Emil.
All right. All right, thanks everyone. Welcome back. I see you, Hugo, you left something. That's why I wasn't sure if it was another question in the chat. But all right, so hope everyone's ready back to start the second half.
I'm going to share again.
Matthijs.
No,
Yes,
I'm going to say,
thanks.
I'll share again now. So just a second. As you can start, so long as about the single discretionary allowances.
Yeah, but I wanted to move back to the slide before that. How are funds being sent back to South Africa? I often have people tell me they just go into their app or open one of these online banks and they send it to South Africa. But what they forget is what type of account is being opened and how are those funds reported to the Reserve Bank? How is the BOB reporting done that goes to the Reserve Bank? And we also see SARS gets hold of that information, because if you are registered with SARS as a tax non-resident and you send funds in a resident via a resident account using the resident BOP reports, we often see that SARS then changes those people back to residents, or they raise queries after submitting a zero return asking, but then why do you bank rands in a resident account? So it creates problems. So that is why it's very important when doing those international transfers that you've got the correct account and make sure that it is reported correctly. Thanks. Then we can move on, Hugo, to the allowances.
Yeah, Matthijs, I also want to quickly add is that with this new change about the in and outs and the update about tax clearances, if you don't have the evidence, I foresee a big problem now with Wise, Resolute, and all these other transfers, because the BOB code is incorrect or missing. So you will not be able to go back on that in-out principle and get your money out of the country. So I don't know how you feel, but I think the latest update has now brought clarity. You can use those disruptive banks, if I can call it that, and you can use crypto to bring money into South Africa. But unfortunately, because it was not banked in a foreign currency and converted in South Africa, you have no evidence to take your money out. I don't know if you have a different opinion.
No, it does create lots of problems, maybe not today when banking the funds, but surely when you want to externalize it in 2030 or even 2 years' time.
Yeah, so that's the bottom part of that slide now, the in-out principle, but back to you on the rest of the slide. Thanks, Matthijs.
Yeah, so as we've seen when Hugo touched on the... Can everybody still hear me? I just got a message that there's a Zoom error on my side.
I can hear you, Matthijs.
Okay, great. Okay, so tax residency plays a pivotal role in the context of exchange control and its application, as Hugo alluded to in the previous half of the seminar. So it's very important to distinguish between residents and non-residents. As a South African resident, you have the 1 million single discretionary allowance, for which no approval is required. You need to be 18 years or older. You have to have a South African tax number, and then you can transfer those funds out for any legitimate purpose. It's mentioned there again, no approval is required. Then for funds in excess of that, the 10 million foreign investment allowance, or the foreign capital allowance as it is referred to, for that one requires the SARS AIT, the approval of international transfer. As we said earlier, it is possible to transfer more than 10 million out of the country. You first need the SARS AIT. Say, for instance, you apply for 15, and then you approach the Reserve Bank with it. That exact same documents that you submitted to SARS, they might come back with additional questions. So because I always tell clients, SARS looks at it via a magnifying glass, and then the Reserve Bank zooms in a little bit. They'll look through it under a microscope. So be sure to include all of the relevant facts and set out the circumstances when making such an application. Also, the in and out principle when introducing foreign earnings to South Africa. and you buy, for instance, a house, you one day sell the house, you are then allowed to take out those funds without getting an AIT, and we call that the in and out principle. There is specific reference to that in the manual. I'm sorry, I haven't quoted the reference there. Right, moving along.
So this, Matthijs, is now we've seen it as experience, but now it's in the manual, okay? It is to be a non-resident, you have to get an AIT. And people who do not have money, I don't know how they're going to get that AIT. That's the non-resident letter. It's not a TCS, so there's no PIN to it. It has no expiry date, and there's just a general comment within 21 business days of coming back to South Africa, you need to actually declare it.
Can you just move back to the slide, please?
This one, yeah.
Yes, please. So there, the issue date at the top says the day SARS issued the letter of ceasing to be a tax resident. But look at the bottom there, the effective date is the day it was backdated to. So the day that person left South Africa and they could provide a passport stamp and show to SARS, that is when they exited the country. So this letter was only issued in 2024, but it was backdated, the effective date of ceasing tax residency, to 2011.
Good.
Thank you.
Right. So now we at private individuals who cease to be a resident for tax purposes. Okay. Now, this is the Reserve Bank side. So we assume that we know the processes at the taxman side. And quite interesting is that that letter does not state whether you're treaty non-resident or no longer ordinarily resident. The Reserve Bank seems to not really be concerned, okay? So you could be someone who, like myself, is living in Dubai on a 2-year work visa, and the treaty could make me deemed tax resident in the UAE if I had a home in the UAE. So in my case, I have no permanent home in the UAE, so the tax treaty makes me deemed exclusively tax resident in South Africa. But should I have that money in Dubai, interesting, you rent a home for a year in advance. If I can throw out 1.2 million, rent a property, then I'll probably be tax resident in the UAE. But the Reserve Bank makes no difference between us. So over to you, Matthijs, to just go through the processes at the Reserve Bank. And then the slide does not deal with it, but it then has this implication that you have to have your shares stamped non-resident. We'll deal with that later, but if you can just deal with this slide specifically.
Okay, yeah. Looking at the second bullet point, authorized dealers may allow the transfer of assets abroad, provided that such a private individual has firstly ceased to be resident for tax purpose, that is that letter on the previous slide we saw, and has obtained a TCS PIN letter in respect of an AIT, the approval of international transfer, where that private individual is registered on the SARS database, or a manual letter of compliance. Moving on to the next bullet point, is tax compliant upon verification of the TCS. That is that letter where you get the PIN, and which is normally valid for 12 months. The amount to be transferred does not exceed the amount approved by SARS, but remember, there are provisions in the manual where you can externalize post-immigration income, like interest earned on a balance, without any approval. Say, for instance, the AIT was approved for 10 million, but that 10 million was sitting in that account for more than a month. It earned interest, so it is now more than 10 million. That excess interest on that 10 million can then also legally leave South Africa without you having to apply for a bigger amount, because remember, the AIT for 10 million will be the amount that you can prove in a bank account. So that's just that.
And then, Matthijs, the next one there, when it comes to the transfer of income, that is not subject to an AIT. But my deduction, or I assume now, to be exchange control post-immigration income, you need to first do the AIT, so that your bank account can be stamped or, I don't know, converted to what they call an immigrant's account. That's the term
Yeah,
you use.
it's not converted, is it? It's a different account because the banks have got different numbers for the different set of accounts. Yes.
So then to get your income out without an AIT, you first have to have one AIT. So if you have no assets, but you only have the living annuity, you unfortunately will have to do the AIT to get that income out. Okay. And that the first bullet point, sub-bullet point, income from trust. Remember there was a query, Danny, earlier about now SARS, after the Reserve Bank or the AD wants an AIT from that beneficiary that is tax non-resident, okay? And that goes with the requirement before a person is treated as exchange control non-resident. It's not this slide, it's way back when I started, okay? Now a letter, and you need an AIT PIN. And thereafter, then the income from trust can go out. But then you don't every year need an AIT again. Seems like that AIT will now last you forever. Now, on an annual basis, you must be showing that it's income from the trust, both inter vivos and mortis causa, but you need to have a TCS good standing. Yet, look at the green highlight at the top. If the TCS is applicable, if you are inactive on the tax database, okay, then you don't get a TCS, and you can then get that letter from SARS. But the problem is, up to 10 million, SARS is not obliged to give you that letter. You can beg them, maybe they do it. But very important, I'm warning you that although as of 1 March 2024, income distributions from a South African trust to a non-resident is taxed in the trust, the form still asks you to detail all the UBOs who got a distribution, even if it's a cash distribution that attracts no capital gains tax. That will cause a tax number. So it is my assumption that any beneficiary of a trust, be it an inter vivos or mortis causa trust, cannot go without a tax number in South Africa. It's the reality. That's how the cookie crumbles. The principle is that you don't need an annual AIT, but I foresee it's going to happen. Back to you, Matthijs.
And then, yeah, very important is that this post-immigration income at the bottom of, let's look at the middle of the slide, the second last bullet, that cash bonus, salaries and fees for services rendered outside of SA. So the post-immigration income. So what often happens is spouses, or not just necessarily spouses, but people immigrate, and the one spouse may retain their South African work. That company can then legally pay to that person that has ceased tax residency directly abroad. If they're resident, they need to pay to the South African bank account, and that individual needs to then use their allowances to externalize those funds. But once you've ceased tax residency, the company can pay directly to that non-resident. So that is a very, very nice to have, and
but
we've got lots of clients.
That process is then an application by the South African employer who will need your immigration letter.
Yes, correct. And in the past, if it was related parties, say for instance, this non-resident person was a director or a shareholder of that company, you had to go to the Reserve Bank. But since last year, they no longer need to. You don't need to go to the Reserve Bank. It can be dealt with on authorized dealer level. So the bank can actually approve that application internally.
It's a relatively quick process and advisable because it takes away the need for an AIT.
Yes, and it's also very important that the work contract is updated, because they might have an old work contract lying around from the 1980s or the 1990s, but they never updated it. So it's always advisable either to do a new agreement or an addendum to the existing agreement, authorizing that person to be abroad and actually perform their work from abroad, because the banks do check. It's not just a tick box approach. They actually do read some of those contracts we see. Okay, so moving on to transfers in respect of dividends. That dividends, if you earn those dividends in South Africa and you've ceased tax residency, they can also leave South Africa without needing to apply for an AIT for those funds to leave. But we do see the banks insisting on those share certificates to be stamped non-resident and they've also got a whole list of other requirements, but we've successfully assisted clients externalizing those dividends without physically applying to SARS for permission for those dividends to leave, because the manual makes provision for that post-immigration income to leave.
And Matthijs, one of the things that I always remind people is not in the exchange control manual, but remember, if you're not a resident of Australia, you can ask for the 20% to be lowered to 15. So
that's the other important part, yes.
Do submit your tax residency certificate from Australia on an annual basis to the South African share register.
The lower dividends tax. I don't know whether there was anything else you wanted me to touch on this slide.
So we can go to the next slide.
We can go on. Private individuals who have ceased to be resident for tax purposes, the new regulation. We saw that you must have that letter from SARS saying that you have ceased tax residency. And obviously, as we've mentioned, it's not the TCS letter.
But now point 3, the bullet point 3 is the one that I've been now telling everybody. That's one of the big changes. Maybe I should have highlighted it. That is now SARS needs to issue you an AIT before the bank will make your bank account an immigrant's bank account. So that is extremely important. And the somewhere else in the slide, we mentioned the fact that if you have tax immigrated and you have less than 100,000, you can do the remaining asset, the cash up to 100,000
yes.
out of TCS. So strictly speaking, even if you have only 10,000 rand and you can get the 100,000 out without the AIT, okay, I'm suggesting go and do the AIT for 100,000. It's a quick one. They want the bank statements for 90 days, and the bank statements must not be older than 14 days. And you must just declare you haven't had any capital gains tax in South Africa for the last 3 years. So, Matthijs, I don't know if there's any other workaround, but I think we must now just roll over and let SARS tickle our stomach, and we do the flippin' AIT, excuse my language, but AITs is the way to go, unfortunately, since the 19th of June. So although the next slide point says, you know, the 10 million can go with good standing only, I can foresee that the banks are going to say, but then we want one AIT. So then in the Matthijs, the next one is that of critical is that the others are existing things, but that plus private individuals may, if you can just take that one through because of the 1 million, it's a very important part of the planning. So when I get a client who says to me they want to tax immigrate, I send them to Matthijs because Matthijs must help with the SDA, single discretionary allowance. And Matthijs, when the people
Matthijs has gone off. I don't know what's happened.
Okay. I'll quickly run through. I think his internet connection is probably not too good. So quite interesting is that once that 10 million, once that 1 million has not been utilized, now you're tax non-resident and you're in the calendar year that it happened. Okay, so that's the 24 tax year of that example letter. Now in this calendar year, you can still take up to 1 million, but now as travel allowance. You can't advance money to your friends. You can't invest. You can only take as a traveling allowance, okay? And only the remaining part of it. It's a once off. It's only in the year that SARS issues the letter, not the year that is backdated from the effective date. And the unused portion may not be carried to the next year. Okay, so therefore, that traveling allowance is now a once-off and it's gone. The reason why they no longer want you to use the traveling allowance is, remember, post-immigration income is freely remittable. All you need to do is a TCS good standing. And remember, on the R1 million, there's no need for TCS good standing. So that's the reason, and that is how the Reserve Bank is helping SARS. Silently, they won't admit it, but I'm telling you, that's how they help SARS to make sure that non-residents are tax compliant, because now post-immigration income is subject to TCS good standing, where the 1 million for me as a resident is not subject to TCS good standing. So it's very important. And then that last bullet point, that's the other takeaway. There was people that asked, I've been out 6 years. There's some people who say, but my client has done the old formal immigration or financial immigration. The Reserve Bank now clearly states, in respect of further transfers of remaining assets, and I'm just saying star, below 100,000 cash, you don't need to worry about this, will be subject to a TCS application in respect of AIT, of the date of immigration or cessation of tax residency, even if prior or after. So it doesn't matter. If you are tax non-resident, you are now in the TCS system, okay? And therefore, you need a tax number. The only people who can go without a tax number, who can have the manual letter of compliance, is those people who are inactive on the SARS system. And that is extremely difficult to become inactive because we have this third-party registration process. If you're a beneficiary in a trust, I'm warning you, if the accountant files the tax return and show that you got cash, even tax-free, SARS is going to give you a new tax number again, or reactivate your old one. Okay.
No, I'm back. Sorry for disappearing.
Okay. When you want to take over, we just started with the slide, Matthijs, you can just go there.
Okay, so 2 concepts of remaining assets was retained and TCS AIT is always required. The externalization of listed and unlisted domestic securities, the process changed. See the relevant slide. Pre-retirement withdrawals, benefits from retirement funds, lump sum benefits from pension funds, pension preservation, provident preservation, and retirement annuity funds. When South African residents cease to be residents for tax purposes in South Africa, in certain cases, payment of lump sum benefits of such individuals will only be allowed by SARS if the individual member has remained a tax non-resident for at least 3 consecutive tax years. That is very important to note. Where a retirement fund and its administrator has obtained a tax directive from SARS for a pre-retirement lump sum withdrawal benefit, the tax directive serves as proof that the individual member meets the above requirements.
Matthijs, this is now the first time that it's now in words, and we have seen this with some of our clients that the funds are far more difficult. SARS only wants a tax immigration letter, a tax residency certificate once, whether you backdate or not backdate, okay? But now the funds want one for each of that 3 years, and they must not be older than 6 months. So SARS has just pushed this, FinServ has just pushed this compliance ticking to the funds, and the funds are, most of them, extremely difficult. So although I can immigrate you on one tax residency letter that's 3 or 4 years old, expect your fund to want the last 3 tax years, and the certificate must not be older than 6 months. So that's really problematic. It makes the encashment on the 3-year rule very complex. Over to you, Matthijs.
Thank you. All assets that were previously blocked as per a specific directive that was given by the Financial Surveillance Department in terms of the provisions of the exchange regulations 4(2) may be dealt with as follows, and here they are. Where a private individual ceases to be resident for South African tax purposes and has a total remaining cash balance not exceeding 100,000, those funds can leave South Africa.
So Matthijs, it's not per bank account, it's in total between all the bank accounts you have. So it's best to take it to one bank account.
Yes, and why run up the cost, of paying for different bank accounts, although some of those Forex accounts don't have any monthly banking fees. So that's really nice to know. For any transfers above 10 million, the requirements of number 7 above will apply. And then the red part with regards to
that's 7, sorry, I should have just elaborated. That is the going to the FinServ. You can no longer, the authorized dealer can no longer do it. So that one refers to the new change that all applications above 10 million is by FinServ only.
Yeah. with regards to non-residents and private individuals who cease to be resident for tax purposes, who are not registered on SARS, are inactive, SARS will issue a manual letter of compliance. International money transfers in respect of income or capital distributions to such beneficiaries. Then, with regard to a pre-inheritance gift, such funds may be transferred abroad, subject to the TCS process, which we discussed earlier.
But Matthijs, that's important now. It must be by the donor, okay? With the result is, if you are saying it's a pre-inheritance gift, SARS is going to ask, where's the donations tax? Remember, we had that one client who was the beneficiary of that trust in England. And
Yes.
Ilse, the lady who was doing his tax, she immediately submitted as part of the AIT approval, the mom paying the donations tax. And she
Yes.
got it within 2-3 weeks. So it's not a complex process.
No.
So although this is relatively new, it's not brand new. It's been there about 2 years, from 2023. You can send the donations, you can send the proof of donations tax to SARS as the source of funds, and they will allow you to send the money out.
And I've also seen that the banks also call for that proof that the donations
Even
tax
so,
has
the
been
bank does
paid.
a second check.
Yes.
Interesting.
Yeah. Yeah. They're very scared to do something something wrong. Okay, so applications by private individuals who cease to be residents for tax purposes and who are no longer active on the SARS database and receive an inheritance or life insurance policy payout up to 10 million will not be required to apply to SARS for a manual letter of compliance. You see those people who have left many years ago that did not notify SARS, so they are still seen as a resident. Then they have to go through the entire process. If they did it way back in the day, they could have gotten hold of their 10 millions much easier and much sooner, because some of these immigrations do take time, because the people no longer have records of their old passports and the old stamps, going back many years. So very important that it is.
Yeah, Matthijs, just to come back to that question Danny had posed to us, that guy who's been out of the country 6 years. So he meets the test, who ceased to be a resident. He is non-resident. But in reality, the AD is going to ask for that SARS letter. So back to that comment I made earlier, whether you did financial immigration, whether you did nothing, you now need to get that tax number active and get the TCS AIT and the immigration letter. It's no longer negotiable. It's a frustration, but that's now how the cookie crumbles.
Yeah. And remember, when seizing tax residency, it's not like the old financial immigration where you could not retain South African assets or have those assets blocked. You can keep whatever you like in South Africa.
You can reinvest back into South Africa as well.
Yes. Yeah. Okay, applications by private individuals who cease to be resident for tax purposes and who are no longer active on the SARS registered database can receive an inheritance of or life insurance of up to 10 million, will not be required to apply for the SARS manual letter of compliance or for the transfer of funds. It includes both own assets and or a beneficiary, and excluding lump sum benefits from pensions. For
quickly, and although this is now inheritance, you remember we had a day or two ago that consultation with the American Family Office of the lady. So the background is this lady has tax immigrated. I've done her tax immigration. Her bank account is non-resident. So everything is hunky-dory. Then her father became terminally ill, and because the insurance had a clause that if you're terminally ill, you can ask for the insurance to be paid out prior to death. So what happened is the Momentum paid this money to her or her company in the US without getting SARS approval. So it's quite interesting is that I then made a phone call to one or two of my colleagues dealing with these life insurance payouts. He's not specifically, he's at Old Mutual, not at Momentum, but he says that on the system, if they have proof that the beneficiary, the recipient, is tax non-resident, They just pay. They're not aware of this requirement that you must be inactive on the SARS system. So I said to him, strictly speaking, it should have gone to a South African bank account, and then we had to do an AIT because it's an asset, okay? And this rule for below 10 million only speaks to people no longer active. And this lady, as you know, is still active on the tax system. And they indicated to us that's how it got out, because just as background, Matthijs wanted to get a copy of that approval from the insurance company where they got Reserve Bank approval. The reason was that insurance went out as a guarantee against the loan from the American family company or family office. And we want to close that loan off as shown as repaid at the Reserve Bank. And it's just impossible to life insurance. They just come back and said they didn't need permission. Money has flown out and it's not our problem, or they as the insurance. So it leaves us with a bit of a conundrum that the Reserve Bank manual says you must be inactive, and I highlighted there. But we see in real life, the insurance companies couldn't be bothered. Back to you, Matthijs.
Yeah, as we say in Afrikaans, Adam sê dis Eva en Eva sê dis die slang.
Yeah.
And that's exactly what happened there. Okay, so for applications above 10 million, applicants are required to obtain a manual letter of compliance from SARS. Moving on to the inter vivos trust in respect of income and capital distributions. Distributions may be transferred abroad subject to the TCS process.
Matthijs, that's now the new change, okay? And that's that lady, the question right in the beginning, Danny. Subject to TCS process being completed by the private individuals and or the beneficiaries of the trust. So that TCS is the AIT. Okay.
Yeah, and then remember for the non-resident beneficiaries that tax must be paid in the trust first.
Yeah.
So not always ideal. For a transfer above 10 million, SARB approval is required, as we've also said earlier. With regards to non-residents and private individuals who cease to be residents for tax purposes, who are not registered on the SARS database and are inactive, SARS will issue a manual letter of compliance for international transfers in respect of income or capital contributions to such beneficiaries. The TCS process, an AIT for assets, no AIT for post-immigration income is required.
But still a TCS good standing.
Yes, they do. The banks do check on that TCS good standing before that post-immigration income can leave.
So Matthijs, this is now your shares, the frustration of your life at the moment.
Yes, tell me about it. Share certificates not being endorsed, different banks following different approaches when it comes to people that are ceased tax residency and retains South African shares. We're not now dealing with where a person has ceased tax residency and then thereafter acquires South African shares. Obviously, in such a case, new funds must flow into the country, and then to have those shares endorsed non-resident is fairly easy, but the issue comes in when a person ceases tax residency and has remaining South African assets, in this case shares in a private company. To get those endorsed is sometimes a nightmare depending on which bank you deal with, and there's a requirement in the manual for those shares to be endorsed non-resident in order for dividends, post-immigration dividends, to flow out of the country. Remember, one does not need a specific AIT for the post-immigration income. So if you want to externalize post-immigration income as in dividends, that share certificates of the South African company must be endorsed. So looking at the slides, shares listed and unlisted in South African companies held as a remaining asset. The externalization of listed and unlisted domestic securities by individuals who cease to be resident for tax purposes will be treated similarly to cash. I think the word externalization must be put in bold there, and one can argue, of what externalization means. Some of the banks think if you want to transfer post-immigration the dividends, post-immigration income, that you've now externalized the shares. I don't think so. Externalize it because the shares remain in South Africa. You're not externalizing the shares when you want to move post-immigration income, as in dividends, out of the country. The securities must be endorsed non-resident and or transferred abroad instead of or as if it was cash, meaning that you need a TCS AIT. These transactions will be subject to the TCS process, as I mentioned, and then funds held in non-resident RAND accounts are freely transferable and will accordingly be eligible for investment in locally listed or unlisted securities, financial instruments, and any other assets on behalf of such account holders. These funds may be released.
So this is why getting your bank account changed to what you call that immigration account is so important, because if you later invest, then there's critical part. That money must come from that immigration account. And then at the time when you buy the shares in the unlisted family company, you need to get the Reserve Bank, the authorized dealer, to stamp that shares on that day, because to do it in hindsight, 3 years later, people have lost the information, and there's no SWIFT transfer document because it didn't come from a foreign bank. It was an internal bank transfer. So this theory is nice. It's a nice relaxation. But I think, Matthijs, the message we have to give it to our clients is do it at that moment. Don't wait.
Yeah. And then also very important, referring back to the immigrant account, that is for a person that has ceased tax residency. They must change their bank account to that of an immigrant. When you apply for an AIT, that AIT will state whether it is a resident AIT or a non-resident AIT. So when you have the AIT and it refers to non-resident, you will not be able to transact on a resident account using a resident account to externalize those funds. You first need to then apply for an immigrant account, and then you will be able to externalize those funds.
Perfect. Thanks, Matthijs. So I think the big message you're giving to the attendees is that there is now a bit more certainty. Some of these processes still confuse us, but it is no longer an automatic thing. Some of them must go past the Reserve Bank. Some must go to the authorized dealer. So I think the take-home message now is that anyone that is non-resident that has remaining South African assets need an exchange control specialist that's not his bank manager, because I cannot see bank managers keeping up to date with all these new exchange control rules, so and that's exactly the service you provide. Is that correct?
Correct. And we often see that some of these, not necessarily high net worth individuals, but individuals with private bankers give them advice, and then it's way outdated. Some of the things might have changed 5 years ago, and then the advice they then get from that banker is incorrect. And once it gets to the exchange control team, when they want to externalize the funds, they call for the relevant stuff. And then those poor people come.
Not just the bankers, Mr. B, that guy in Australia, where we took so long to get his AIT because his number was inactive, and his immigration letter. Remember 6 weeks ago, his financial advisor still asked for the Reserve Bank letter of immigration. I mean, crazy. I mean, it's now 5 years later. We're going in March next year. It's 4.5 years later after they switched off formal immigration, and insurance broker still asks for that letter. So yeah, but anyway, apologies. But now we're going on to the other issues. Let me just get some water. So what I did is I used the sign for Bitcoin, but I'm dealing with all crypto. So that's why I made it in green. So it's not just Bitcoin, it's all crypto assets, okay? Apologies. So this is the topics we're going to quickly run through because I know we're running out of time. I'm not going to read slide by slide all the detail. I'm going to highlight the important. So none of these are new. They're all existing, But we know that this is where people get into trouble with the Reserve Bank, okay? So first of all, crypto and trading platforms, okay? And trading platforms, that's ETFs, so it's not just crypto. Private individuals may only fund online international trading accounts, ETFs, and crypto as registered brokers in terms of the single, at a registered broker, in terms of the single discretionary amount. You cannot use your debit and credit cards for that. ADs must convert the rand into the foreign currency in South Africa and transfer the funds, the foreign funds, the forex, into the bank account of the agent, okay? And the account can also, money can also be deposited in the foreign currency account at the authorized dealer. So remember, like myself, who has a dollar account, if I wanted to buy crypto, I can transfer it from my rand account into the client foreign currency account, and from there to the broker if I want to buy Luno or whatever, okay? Card holders must note that South African credit debit cards and virtual cards may not be used to fund any international trading accounts, fund any. So you can't say I'm just transferring it to that bank account. Therefore, I can use my credit card. So if you have a Wise account, an Interactive Brokers, Swiss Quote, all these online share accounts, okay, you cannot fund it using your card. So it falls within your million, but you have to do a SWIFT transfer, okay? Then on the second column from the left, residents or individual local entities in whose name one or more bank credit cards have been issued may be permitted to make permissible currency purchases for small purchases. So this one is resident individuals or local entities. Can you see up till now, we dealt with resident individuals. Now, Sunday, when it comes to credit debit card use for online, you can use your company card to pay for your, Matthijs, what type of license? You and I pay our Microsoft license using our debit card from the company, okay? Totally allowed, okay? But the limit is 50,000 per transaction, and any singular transaction exceeding 50,000 may not be split into multiple transactions, 5 days to get to 250. They're going to pick it up. They have the monitoring system for that, okay? Then you may also not use the credit card to fund your foreign currency accounts. You have to use the SWIFT. And then on the right-hand side, online international trading accounts, inter alia includes trading in global currencies against each other, not just crypto, okay? So it's very important that if it's trading in commodities or currency, doesn't matter, okay? And then the gray one, the block at the bottom, that's extremely important. Residents may not use their credit and debit cards in South Africa to facilitate payments in respect of payment of a foreign lottery ticket. So I've had a client, and unfortunately, if you look at it in Dubai, there's only been that I'm aware of, and you can see the winners on their page. One South African who won $1 million on a lottery at the Dubai airport. So when he boarded the aeroplane, he bought this ticket, swiped his South African credit card, transaction went through, no one stopped it. When he won that prize, the Reserve Bank wanted to forfeit that money. They eventually allowed him to keep the money, and the administrative penalty, listen to this, the administrative penalty was 40%. They took $400,000 of his $1 million because he used a South African credit card to buy the lottery at the airport. So although that sentence there says in South Africa, they interpret that widely because they say, their argument was, because you swipe it outside the country, but it's still processed with a South African bank, it's treated as an in South Africa transaction. Okay. Now we're at Circular 14, and that is the new change, and that's the question I said we'll go into detail. So I'm going to discuss it as it's been changed, but I'm giving you old and new information. And Matthijs, you're welcome to interject, okay? So capital distributions from local testamentary trust. Remember earlier, we had capital and income. Now I'm dealing with a capital distribution from a local testamentary trust, okay? And you'll remember that when we looked at the legacies, they said own all beneficiary assets. Now, if you were a vested beneficiary in a testamentary trust, okay? So what happened is Dad gave the property to you and your brother to be held in trust because the income goes to your mom. You were a vested asset beneficiary, or that was a Bewinst trust. Okay. Those assets can now leave as well from the 19th of June. Okay. So that is not truly a capital distribution because you've always been the owner. Okay. But you can now, if mom has died and the trust dissolves or the trustees gives the resolution, you can now get a capital distribution from the local testamentary trust. Okay. And it may be remitted abroad, provided the trustees' resolution confirms. So although there's a will that says that, they now need a trustee statement saying the income beneficiary has died, the asset can now be distributed, or the proceeds can be distributed. But if your sister is in South Africa and you try to be clever and she renounces her right to 1/2 of the property so that you can take the full proceeds out, they can see it because the will says the property was inherited in equal portions. Then this must still go to FinServ, the bank, the AD, authorized dealer can't make that decision. Okay, so that's a special application, 6 weeks to 12 weeks. The attention of private individuals who cease to be a resident for tax purposes is drawn to the requirements of B2J. And remember from earlier I said, J deals with people who cease to be tax residents. If no longer active then on the system, then you can go for the manual letter of compliance for transfer of funds. So there's two at SARS. There's one that says you're just compliant, but you need permission that you can transfer the funds, which means in their manual process, SARS are going to ask proof that the capital gains tax was paid. Now remember, although you're non-resident, your vested right was in a title deed. And therefore, as Matthijs alluded earlier, you are subject to 7.5% withholding tax. So please, before you do this application, go and speak to a tax advisor and tick off all the tax boxes, because SARS is going to ask who paid the capital gains tax. If it was a vested asset, the capital gains tax is yours, then it's 7.5%. If the capital gains tax is payable by the trust, so you were not a vested beneficiary, they now vest the capital in you, okay? Then unfortunately, sadly for you, the capital gains tax is payable by a resident trust, and the capital gains tax is flat 36%. Okay, and Matthijs and I have just had that with, remember I mentioned the lady where her mother made the donations tax and then she got her donation out. That mother sadly died in December of 2024, and the trust in South Africa had to be dissolved. All that capital gains tax on, was it 200 million rand, Matthijs, had to be paid in South Africa at 36%. And now only can we get the money out. It's what, 6-7 months later, and we still have to go through the process of a deceased estate being registered, and SARS is asking so many questions.
And then after SARS, we must go to the Reserve Bank still also.
Yeah, so we still, the next step is, but now we then had to go back, and that's the example of the person earlier that I said, sorry, you had to create a tax number before because this, remember, the change is now 19th of June that you have to get a tax number. At that stage already, the Reserve Bank said to us, sorry, this lady will have to get a tax number. So I initially wanted to not create a local bank account so that she doesn't trigger a tax number, but the Reserve Bank was just not prepared to allow the distribution from the South African trust. We had to go and register her for tax. Then we had to backdate her immigration to, was it 1995, Matthijs? That's how long she's been out of the country. And now only can we do that. So the process from December till now has been reactivating her. So we had a problem. If we entered her South African ID number, the system said she's inactive, okay? Then you couldn't do an online registration. We then had to have a meeting through that lady, Lucia. So if you need Lucia, she's my solutions lady, my go-to. She then had to have a meeting with SARS to override that inactive status, to then create a tax number. And then strangely enough, she got a new tax number because that inactive number was given to someone else. Now she has a new tax number. Then we had to do an immigration, backdated to 95. Then SARS was on us, all over us, because there's exit tax. We're saying 1995, there was no capital gains tax in 1995, so no exit tax. That took 3 months. Now we're at the Reserve Bank process, and now we're over 10 million, and the Reserve Bank says we want source of funds. So until they resolve or give me financial statements for the trust or for the liquidation and distribution account from the mom, Matthijs and I are stuck. We can't go to the Reserve Bank to show source of funds. Okay. And this approval, we can't get an override. The trustees was the bank, one of the banks in South Africa, but it's FinServ that needs to give it. Okay. Matthijs, over to you on the digital nomads, because you're the law firm help with these digital nomad people as well, do you?
Yes, so yeah, we've got a whole immigration department assisting clients with all sorts of visas. At the top of the slide, foreign nationals with consent to bank. That is what we also call a B5 declaration, where a foreigner signs a document with the bank when opening up the bank account, acknowledging that they've got assets offshore, and then they can bank as a local. They can have a South African bank.
I just want to quickly say the reason why they're still foreign nationals is because they get a visa, but they don't have a South African ID. It's the South African ID that changes them from a foreign national to a resident. Is that correct?
Correct, yes. Those people can then open up a bank account in South Africa where they can bank dollars, pounds, euros, and also rands. So that's just dealing with that. There's no restriction on opening up such a bank account, but it is important that it is done correctly and that the B5 declaration is signed. And also retain a copy of that, because your bank might not have kept a copy and you may need to have that within 5 years. Foreign nationals has got no SDA. The general guidance is given here, but certain exceptions. Where if you've earned local income that can be sent out, but a nomad visa does not allow local employment. So a person that is a digital nomad that's employed by a company offshore, they will typically bring in those funds from abroad, and they would also be able to take it out, provided that they can show how it was introduced and all sorts of other things the banks may request. Sorry, Hugo, you were busy saying?
I'm just saying the general guidance is no IIT, but now we have that Walter client, remember? He bought the property in South Africa so long ago, then lived in South Africa for a while, but never got an ID. And now he can't, on the in-out principle, prove that he has the, that he brought the money in. And now we have to register him for tax, okay? He has to get the withholding tax directive. And now we have to do an AIT to get the money out. And the AIT was done, but because he's a foreign national, they want an AIT as a non-resident. So now we have to go and artificially tax immigrate him. He's never ceased tax residency, but they want an AIT. So if it seems to me that the foreign nationals are all okay as long as they can show the money, the in and out, or where it comes from. But when it's property and there's a capital gain, you and I were happy in the past that, you know, when we had the 7.5% withholding tax was paid, and you could show the directive from SARS, and you could show when the property was bought for $1 million, now it's 10 million, they allowed 10 million out. So it was more than in and out. But the problem is a lot of these foreign nationals who held properties in South Africa for a long time, Matthijs, has no evidence of that in-out. And it's this experience that we are saying to people, be very careful to use Wise, Resolute, and all these other disruptive transfers and crypto, because you do not have proof of in-out.
Yeah, and the funds that people using those platforms introduced is rands, because remember, it gets exchanged offshore. So they're only introducing rands, and probably in the incorrect way, using the incorrect BOP code. So good luck getting those funds out in a couple of years' time.
So Matthijs, I gave the links that you guys use. You know, we're not here to really provide home affairs, but very important is that in the tax side of these immigrants, okay, to get that permit done, there must be tax compliance, one or two. One is if the recipient of the visa is a tax resident in the country, with whom we have a treaty, okay, comes from England, the recipient will be required to register with SARS if they are in the Republic for longer than an aggregate of 183 days during any 12-month period. Now, that's quite interesting because at the time he applies, he's probably not here. But if he applies for a visa for 36 months, they assume he's going to meet that 183 days. Therefore, for people who apply for longer than 6 months, because the visa is 6 to 36 months, they need a tax number. They're not tax resident, they just need a tax number. The number 2 option is, if the recipient is from a country where we have no treaty, okay, that is Philippines, Panama, that person needs a tax number from day one. The reason for that is a nomad may not be employed in South Africa for the nomad visa. They must be employed by a foreign company. Then in our treaty countries, all our treaties says that if you're employed by a foreign company and you spend less than 183 days, some is 180 days, in aggregate in any 12-month period in South Africa, then South Africa has no right to tax you. But sadly, on day 184, SARS gets the right to tax you from day one. So they must then go and get a refund in their country or upfront claim the exemption. Okay, so that is very, very important that they do that. And I know for the US, for example, if you can show to the IRS that you have a South African tax number, you paid tax in South Africa and you have a home or rented place in South Africa, then their equivalent of 1.25 million is about 132,500 US dollars, and it's substantial, okay? And then point C is the holder of a remote work visa is not entitled to take up employment in South Africa. As per existing immigration regulation, no person holding a remote work visa may apply for a change of status to his or her visa while in South Africa. So they can leave and then apply for a work permit or a permanent residency, because what we envisage here is within 36 months, they are probably going to find a girlfriend, a boyfriend, or a spouse in terms of South African tax law. Okay, so there's the actual application form. And it's, sorry, I said 6 months, it's exceeding 3 months up to 3 years. That's the process, okay? Then I've already explained the rules. For the more than 3 months, less than 6 months, probably no tax problem in South Africa. The minute you go over the 183 days, then first of all, you have a problem that you're going to be taxed in South Africa. And secondly, if you earn substantial interest and you're more than 183 days in South Africa in a tax year, then the interest becomes taxable in South Africa. So very important is that when that nomad comes to South Africa, they're not going to be a quick tax resident. So America, 3 years, UK, 1 year, or less than 1 year. In South Africa, the normal rule applies, it's 5 years. And then in the 6th year, they must be here more than 91 days, okay? And very, very important is that in that entire period, that person is a foreign national with consent to bank in South Africa. And when they open that bank account, please, as Matthijs said, let them do the B5 declaration and keep that on record that you have proof of that, okay? And there's, in my case, then in green there, no indication that that nomad will be deemed to be ordinarily resident in South Africa. So remember, the ordinarily tax residency rule overrides the physical presence. But if they get married to a South African or become a spouse of a South African resident, then interpretation note 3 says they now ordinarily residents. Okay, so only towards the end of the second nomad circle, for visas that commence in 24, will we have this problem of the probable tax residency coming up. Okay, then independent personal services rules, what we're just trying to show to you, we're not going to go into detail, is if you're an employee of a foreign company, you have the protection. But if you're an independent contractor, you do not have that requirements, okay? So in the yellow there, income derived by an individual who is a resident of the USA in respect of professional service or other activities of an independent character, a true contractor, shall be only taxable in the USA. So that's an exception in the USA agreement. If a CPA comes to work here, chartered professional accountant, they will not become. But if they're coming from England, they will become tax residents. So also look at each treaty for people who are not in normal employment. Then also the US has this rule: if he has a fixed base, the income may be taxed in South Africa, but only so much of it as attributable, sorry for that, to the South African base. So the work he's doing in South Africa. If he then works remotely and he does work for America, then it's probably not taxed here. However, if he has a fixed base, but it's not a hotel room, okay, then that will probably be part of this, okay. So now, Matthijs, back to you on foreign nationals. No South African ID, not a CMA resident. The rules applicable to them from a Reserve Bank side.
Yeah, CMA refers to Common Monetary Area. Foreign nationals temporarily in South Africa, those who are not purely on holiday. They are required to declare in writing with the authorized dealer whether they have foreign assets. That's the B5 declaration we spoke of, and it's very important that that is done when opening up a bank account. On receipt of such completed declaration and undertakings, an authorized dealer may permit such foreign nationals to conduct their banking on a resident basis, yet also conduct non-resident or foreign currency accounts in the books of the authorized dealer. They may dispose of or otherwise invest their foreign assets, including foreign cash funds held by them. Subsequent accruals, as well as foreign income without interference from the Financial Surveillance Department. Then also transfer abroad funds accumulated during their stay in South Africa, provided that the foreign national can substantiate the source from which they have acquired such funds and the value of such funds is reasonable for their income generating activities in South Africa during the period. I just want to make sure you're not doing anything illegal or funny. Okay, immigrants, when referring to exchange control, immigrants mean natural persons who immigrated from countries outside the Common Monetary Area with the firm intention of taking up or having taken up permanent residency in South Africa. Again, we refer there to the B5 declaration that must be signed, and it should be noted.
The last bullet point, Matthijs, is the big one. I think we've covered all the above, but because time is running out, but the bottom one is very...
So just the second last one, in the case of recent immigrants, authorized dealer must satisfy themselves that the requirements of the B5 declaration has been met. And it should be noted that while the personal banking of foreign nationals temporarily resident in South Africa may be conducted on a resident basis, and interest held by such individual in local entities will be deemed as non-resident for local financial assistance.
Okay. We're done. So there's a few minutes left. Danny, if there's more questions.
Yeah, so I got a couple of questions I see. So firstly, I have a follow-up question was from someone. I'm South African and a tax practitioner. My son, born in South Africa, has dual citizenship with a Euro passport and has been living in the UK for the past 5 years with his foreign doctor wife and foreign daughter. His earnings abroad is minimum, and the only asset in South Africa is a small bank account. I'm submitting his SA's tax returns to SARS. Not too sure where the question goes with that.
Well, let me just give you an analysis there. I would close that bank account because there's no reason to keep it open if there's no activity. So if there's maybe a small life insurance or something being paid, let mom pay that. That person should rather must go through the process of getting an immigration letter, then become inactive. Ask SARS to close your number, but then you must not have any financial footprint in South Africa, not be a trust beneficiary, don't own property, don't have a bank account. Now, mom can, in her will, state that I bequeath to my non-resident son living in the UK 10 million or 9,999,999 rands, which he can then, I ask my executor to freely remit to him into his UK bank account. Okay, that's the practical side of it. So I think that's where they wanted to go to.
All right. And okay, then I've come across a person when transferring funds out of their South African bank account to their foreign bank account using the code gifts. Is this correct? Should the BOP code used not be the deposits held with a foreign bank investment, or does it depend on the type of account one has?
No, it depends on what was the reason for sending out. If it was an FIA, then you must do it as a foreign investment or disinvestment. But by saying that it's a gift, you are triggering capital gains tax. If it's over 100,000 Rand and that BOP code goes to SARS.
Donations tax.
Donations tax. So no, please don't use that BOP code.
The reason why people do that is to bypass the banking systems. But in the subsequent tax year, they're going to face issues on SARS level.
Because
so don't be stupid is the bottom line.
Yeah. So practical is if you use the code gift, they immediately up to R1 million per calendar year treat that the banking system as SDA, single discretionary allowance. But the donations tax limit is 100,000 per tax year. Mm-hmm. So it could be that you in one tax year, spreading over 2 calendar years, have made 2 million of gifts. Look at the tax. It's like a nightmare. So yeah, please don't use that. And as Matthijs says, don't try and overcome the bank system or circumvent the bank system because you trigger a tax nightmare for yourself.
Okay, and then it's another question. Is it very difficult to obtain a manual letter of compliance?
Yes,
yeah.
Because remember, they have nothing to look at. So my experience is, Matthijs and I have been getting it about 2-3 weeks, but we know what to give. So we give the history. Remember what I said earlier. If it deals with a property, give the explanation when the property was bought. Give the title deed or the deeds office printout. In this Walter client where I referred to, we showed to them the information about he was employed by, he was a guest professor for 17 months in South Africa at University Stellenbosch. We showed when he bought the property was way back in 1988, but we don't have proof of the money coming in. And that's the only one where they declined and then said, okay, now he must register, get a TCS number, immigrate him, and the whole works. But those guys who are truly inactive, the manual letter for above 10 million, relatively easy, but you must give all the documents. On the people below 10 million, rather go in and ask for a manual letter of good standing, because then easier for SARS to issue it. The minute you say a manual letter for international transfer, SARS think there's more than 10 million, they're into audit mode or verification mode. So yes, it's relatively easy, but you have to do the application in the correct way and think if you want a good standing or an international, because there's two. There's a manual letter for good standing and there's a manual letter for international transfer. And strictly speaking, the international transfer is only required for amounts in above 10 million.
So you're saying if it's a 3 million estate inheritance, and
then strictly speaking, you don't need the letter, but that person probably does not have an immigration letter like this Walter client of mine. Okay. So
and you need an appointment. Need to make an appointment to get the manual letter.
So minus there's a specific email address. Matthijs, it's M. It starts with an M. I can't remember it, but there is a. You're going to do an update email later for the people with the link to the recording. Then I'll give you that email address, Danny, that you can share it.
Okay, perfect.
It's an email address. One of my tricks, I copy in PCC at SARS, Practitioner Call Center. I then get a case number, and then I upload everything under the case number. And I've not had meetings.
Okay, perfect. And then finally, I think controlled foreign entities' profits are taxed in an individual's hands. However, losses are not offset against SA residents' taxes. That appears a bit unfair. A client bought 4 properties in the UK, each one in a separate company. 3 of them show profits, while 1 is showing a loss. Unfortunately, the loss in the one cannot be offset against the other profitable ones.
That's interesting because I don't think that rule deals with per foreign entity. It's you're deemed the contributed. I'll have to check that, but it's my gut feeling that you can offset because at the end of the day, the line item on the ITR 12 for CFC is one line item. So you can offset, I think, but I haven't done that for a while, but it's true. But then remember, if it is it depends on which country, if that company has paid, the taxable one has paid 19%, claim the high tax jurisdiction exemption. Don't attribute it back to South Africa. There's, so that's why I'm not too sure, because unless it's a country like Mauritius, that's 15%, or in Dubai, that's 9%. I very seldom have clients who pay tax in South Africa on the CFC route, because most of the jurisdictions have a tax rate, I think it's 67.5% of our company tax rate.
Okay. I think that's all I've seen on my side.
Thanks a million, and thanks, Danny and Stan, for
Thank
the
you.
opportunity. I hope we
Thank you
delivered
again.
on your expectation, and thanks
That's
to the Reserve Bank who
always
announced all these things
informative.
in time, because up till a week ago, if you go to Circular 2, 3, and 4, all these circulars were drafts for comments, and I've not really had the time to check how big difference there is between the original draft and the final ones. But the nice thing is that you allowed me to update this thing overnight, and I could this morning upload the very, very fresh information. So you can really go out proud and tell your attendees they've got the most recent Reserve Bank manual. I have sent it to you if you're welcome to distribute. It's not my document, it's the Reserve Bank. If anyone wants to check the Reserve Bank page, it's resbank.coza. You go to the heading What We Do, then you go to the prudential activities, and you go to the immigration, the exchange control.
Financial surveillance department.
Financial surveillance, and then exchange control.
And then documents.
And then
Financial surveillance department. That sounds a bit ominous.
Yeah.
That is what it is.
Yeah, and there's my Matthijs's email addresses. Be patient, because after meetings like the presentation like this, we normally get swamped with a bit of email. So we'll try our best to get it out as quick as possible. Just for those who, if I don't answer, I'm going on leave. I'm only back on when this tax filing start, 22 July. So poor Matthijs is alone in the office, because Bronwyn from the Dubai office is also on leave. So next week it's Matthijs and Matthijs alone.
Okay, so thanks very much. Very informative. If you have any doubts, you see the email addresses for Hugo and Matthijs. As you heard, Hugo is off before he gets any response to this. And
that's what he says, but he always answers emails whilst on holiday.
Yes, no, I'm sure he does. And thank you very much. We have the next webinar is in July. That's with Cheryl Howard on estates. We'll be sending out the notices very soon, and your certificates will be on their way a little later this afternoon. And once again, Hugo and Matthijs, thanks very much for this afternoon. It was most informative. Even me in my ignorant state, I learned a lot. So thank you, and hope everybody has a good afternoon. You can now all go home if you're not at home. And thank you again.
Thanks a million.
Danny.
Thank
Danny,
you.
anything to add?
No, I'm all good. Thank you again. Cheers.
Thanks.
Bye-bye.
Bye, everyone.